Hello everyone, am I audible to you all? Am I audible to you guys? Hello everyone, So, I guess I'm audible to everyone and I just wanted to ensure that I'm audible because obviously it is a live session for the first time for your paper financial reporting, that is F7. So before that we start with whatever is the motive of doing this revision session of FR. Before that, I just wanted to start with the introduction to FR and introduction of myself. So guys, those who don't know, my name is Meet Panchal and I'm your faculty for IIC Lakshya, Indian Institute of Commerce Lakshya. And here we are going to be learning your financial reporting subject, which is a subject of ACCA of skill level. Now, those who are from the background of ACCA, they might already be knowing about financial reporting, kind of, because they have done it as a subject under the name financial accounting, which is F3, which is a paper of the knowledge level, right? So probably this is just a higher version, or certain pointers or certain chapters are just added to that same portion, and maybe some chapters from the F3 has been removed, which are unnecessary or which are for the base level, right? So we are going to be learning under FR, which is going to be probably a higher version of our F3, that is financial account. After financial reporting in your professional level, again, you will get a higher version of FR, that is nothing but strategic business reporting, that is SBR, right? So about this paper, guys, now students usually have a problem, right? Have a problem in FR, since everyone knows it is for the quarter September 2023, right? So your examinations are going to be held on 7th September, correct? So approximately less than 20 days are pending for you to complete your portion, and students usually have a difficulty in making it understandable to themselves that what they are supposed to do in the section C, right? Students will deal with section A, students will be able to deal with section B. Okay, there's MCQ, so you can deal with it. But how you're supposed to present section C, what kind of questions could be asked in section C? This is a problem for most of the students, right? And that is the reason why our whole gamut of this revision session is to ensure that students are going to be able to learn the section C portion and also ensure that they score marks in the section C as well. Because if there is a possibility of a student failure, it could possibly be because they are not clear, or they are not well versed, or they have not practiced well to ensure they can score much marks in section C. And as you all know, if in case you all don't, your section C comes for 40 marks, in which you will be having two questions. So your two questions are going to be each of 20 marks, which will be usually a consolidated financial statements that you're supposed to prepare, or maybe ratios that you're supposed to calculate. If you're already known to all this, maybe because I'm assuming that most of you all have started with it already, that is FR, right? Because in 2 weeks or maybe in 3 weeks, your examination will be there. So some of you might be prepared, some of you might not be prepared, some of you might be stressed. And is the reason why, no matter at what progress level you are right now, we are here to just help you ensure that your section C is clear. Section A and B can be dealt with separately, right? Now, I'll just talk about myself a little bit more. So, as I told you, my name is Meet Panchal. I'm a faculty at IIC Lakshya for your subject financial reporting, which students consider as a base for their accounting, and also they consider it as a base in the skill level, which because most of the students prefer doing FR as their first paper. Okay. Now FR has a very good pass percentage. Okay. It has a very good pass rate. So you can be rest assured that mostly if you study well, you're going to clear the exam. Okay. Now I have a tutoring experience, not under Lakshya, but under other institutions as well, for financial reporting, financial management, taxation, and also a certified course, which is known as Diploma in IFRS, which teaches the students who are not from the ACCA background about the understanding, about the conceptuality of your IFRSs. Okay. And I've been doing this teaching since past 2 years, right? So, that was all the introduction that I think you all need from my side. I hope it is clear to everyone. I'll just speak a little bit about Lakshya. So, Lakshya is not just a name, it's an aim to ensure that whatever course you're pursuing, whatever career you want to make out of yourself, be it for CA, for ACCA, CMA USA, CMA India, CS, or maybe CAT for MBA, CIMA, all these courses that are there, all are available with Lakshya, right? So students who are not affiliated with Lakshya yet or who are already affiliated with Lakshya, be rest assured that you're going to pursue your course, you're going to be moving towards success in the future date, provided that you work hard, right? Because Lakshya is there to help you for all the students who are very motivated, who are very encouraged to be ensured that you're going to clear the paper. When you go to actually give your FR examination, it should not like be in mind like, oh, maybe I would clear the exam, maybe I would not clear the exam. I don't want that thinking in mind from the student's perspective, right? I want the thinking, okay, at least I can score 65 or at least I can score 75. Or those who think they are very good with FR, I can be an all India rank probably, right? So these kind of thinkings or these kind of aims you all should have when you all are with Lakshya. Now, Lakshya is, as I told you, it is a well-known training institution providing ACCA courses because here mainly we are dealing with ACCA, that is FR of ACCA. It actually teaches courses offline mainly in Kerala. Also, we consistently strive to maintain being the best among the Lakshya is crafted with utmost care, right? So we are concerned about our students, we are concerned about their progress is the reason why you get, in my live sessions also, I usually ask students, what is your progress, how much you've completed and so on. So the ACCA coaching offered by Lakshya is crafted with utmost care. This ensures that we provide the updated ACCA syllabus with intensive training given to the students. So we are rest assured we are going to be providing you with every course, every important topic, every important suggestion that is to be given from our side to you so that you can be very clear with how the examination is conducted and how you're supposed to perform. Okay. And also, this helps you to gain the skills, abilities, and knowledge required to appear for the exam. So, obviously, you will be very much clear with the skills, with the knowledge that you're supposed to get from Lakshya's side, and obviously, the how you're supposed to appear for the examination with being confident, with having confidence in yourself. Okay. We have online and offline sessions classes available in various languages like English, Hindi, and Malayalam. Right. So for students who are having language as a barrier, language should not be a barrier for learning. Right. And is the reason why there is an English YouTube session that will be available, and there will also be a English YouTube session, YouTube revision session available to you all. That is going to be nothing but English and Hindi mixture for those who are having a problem with English. Because the only language or the only communication that we are supposed to learn here is not the language of Hindi or English or any other language. It is going to be the unspoken language of exchange of financial information, which is nothing but your financial report. Right, guys? Now, we're just going to be talking firstly about the gamut of revision. Firstly, just keep this thing in mind. This gamut of revision, it is going to be just a gist of what we do in our online live classes. So we also have our online live classes for the whole subject syllabus covering, right? We are covering the whole FR subject and be it for other subjects as well. That is like, for example, your PM or FM or AFM, AAA, AA, and so on, right? So this here we are just going to learn a gist of the whole financial reporting subject, and mainly we are going to focus on section C sums, the different types of sums that are asked in section C, because that is where students usually have a problem, or that is where students consider it as a stepping stone to clear the examination. Now we'll understand about the conceptual clarity. Okay, so we are going to have a conceptual clarity on what topics. Firstly, my intention is to make it understandable for you all, whichever topic is important, be it for your financial reporting examination or also your future course, that is SBR, that you're supposed to do, and in which the most important topic is nothing but consolidation, right? And in case of consolidation, you're going to prepare the financial statements, in which you're going to have the consolidated statement of financial position and also the consolidated statement of profit or loss. Right, guys? This is going to be the conceptual clarity part. So I'm going to make you understand the whole concept and the base for consolidation. After which, guys, we are going to have to be solving 4 sample questions. In these 4 sample questions, I'm going to be covering 2 sums of your consolidation. Those are going to be from the past papers taken, right? And 1 sum from your ratios. Ratios are you're supposed to calculate the ratios, but the marks are not given for calculating the ratios. Mainly in case of ratios chapter in section C, the marks are given for calculating the ratios and then accordingly interpreting the financial statements, right? So that 1 sum we are going to solve of ratios. So even that is asked in examination. So is the reason I'm making you all do that. Then the fourth one is nothing but your single entity, your individual financial statements that you are supposed to prepare, right? Because that is also a question which is asked, which is frequently asked in your papers. Not so frequently, mostly the frequency of consolidation and ratios is more as compared to the individual financial statements. But obviously, it is important. So we have to do everything that is important in section C, right? After our 4 sample questions, that is involving 2 consolidation sums. One is your uh, one is your consolidated statement of financial position. The other is consolidated statement of profit or loss. The third one that we are going to do is a sum on individual financial statements. And the fourth one is going to be nothing but your ratio sum. Okay. Then we are going to be solving 2 mock papers. So mock papers will give you clarity as to how you're supposed to actually give the examination, or how when you go to give the examination it will look. So as you all know, you have to give a center-based examination wherein you're going to be, computer-based examination in the center, right? Or probably a home-based examination you can choose to have, but it is going to be computer-based, right? That means whatever solving, whatever questions you're supposed to answer, that is going to be on the computer, on the laptop that you're probably having with you, right? So we are going to actually solve 2 mock papers through the CBE platform that is made available by the ACCA, so that you can be rest assured that whatever is the problems with you, not being familiar with this platform, or not being able to understand, or maybe just stress a bit if in case suddenly you see a paper in face and that is not actually a pen and paper, because usually some students are familiar with and comfortable with solving it on pen and paper, right? But this is actually you're supposed to solve the whole paper on your computer, right? So you have to solve the MCQ questions of section A and B, and also the whole solving of section C is going to be on Excel, right? And lastly, whatever are the latest up-to-date changes, the relevant changes to FR that are going to be discussed in this class. Also, something which is going to be discussed in this class is nothing but the 2 important things which has been introduced by ACCA. One is the computer-based examination platform. I will make you understand how you're supposed to get access to the CBE platform. And the second one is the ACCA Study Hub, to ensure that you are very clear with the concepts and with the information that the ACCA has provided. So until now, the students were relying upon the secondary sources, that is the Kaplan kit and the BPP kit, which is actually quite good. And still the students can rely upon that. But ACCA has launched its new ACCA Study Hub so that the students can also prepare their portion for the examination from directly the primary source, that is ACCA itself, right? So we are going to be understanding how we are supposed to get access to ACCA Study Hub, and also how we are supposed to give paper for through the CBE platform, so that the students will be very familiar with the paper when actually giving the examination on 7th September, and they'll be like, oh, I already know of this, how we are supposed to deal with all this, right? So that is the things that we are going to be covering in this YouTube session. Now, ACCA exam support. So whatever we are going to be covering, it is the ACCA support articles, or any technical articles that has been newly launched, any CB practice platform, any real exam experience that we are going to get, because I'm going to be solving the paper directly on the CBE platform, right? The practice questions, as I told you, we're going to be solving 4 sample questions. So we'll just look at them. Mark your answer. Mark your answer is once you're done with the paper on the CBE platform. After that, you can actually check the answer that whether which are correct, which are not, and also give markings to your answer yourself to actually, be assured that this is the score that you're getting. Okay. And obviously your CBE platform that we are going to be covering, it will be shown live in class right now after we complete our conceptual clarity, and also the ACCA study hub will be shown live in class. Okay. So this is the base of your YouTube revision that I've explained you that we are supposed to cover. Once we are done, okay, this is introduction to SBR, but any which ways it is the same thing. That is introduction to F, right? So this is the base that we are going to be covering in this session. And always keep this thing in mind that once we are done with this, if you have practiced well enough and also you're well focused when we are doing this, ACCA FR paper is just a piece of cake, provided you know how to bake it, right? So ACCA is just a metaphor that I was trying to use. Anyway, so it is just a piece of cake if you know how to bake it, and that we are going to help you with, right? So be ready to just, succeed with flourishing marks and be well prepared and having the confidence in you that you're going to clear the examination no matter what. Okay. Now, I'll just explain you the examining marking scheme. So in case of the marking scheme, guys, examination marking scheme, there are going to be 3 sections for your FR paper. Firstly, it is a 100-mark paper. It is a paper of 3 hours 15 minutes, wherein the first 15 minutes are going to be given to you to just read through the CB platform, that how you're supposed to understand and how you're supposed to deal with the interface of the CB platform, right? So 15 minutes will be given to that. Don't think that if you complete that thing in 7 minutes, that 8 minutes will be credited to you for your examination. No, 15 minutes are given for that. You end it at 7 minutes, so you will get 3 hours only for completing the paper. So technically for completing the paper, you're going to be given 3 hours, right? In which case you have your section A, section B, and section C, right? So the first one is section A. Now, in your section A, guys, in your section A, there are going to be 15 questions. Okay. And each question carries 2 marks. Okay. So then in total, you're going to get 30 marks in section A. In section B, guys, the scenario is the same. You're going to have 15 questions and each question is going to carry 2 marks. But these 15 questions are actually subdivided into 3 different parts, right? 5 questions for each part, right? And for each part, you have a scenario given to you. So you will have a full-fledged scenario given to you, and according to the scenario, you will be given 5 questions. So from that scenario, you have 5 questions to be solved, and like that you have 3 scenarios. So overall it makes 15 questions and each question carries 2 marks. So in total you will get 30 marks for section B, right? ACCA has prepared it well. Initially you have to solve smaller questions. It gets bigger with the scenario questions that is given to you, and eventually it gets bigger with the section C sums, that is a full-fledged sum that you're supposed to consolidate or maybe prepare the financial statements for, or maybe calculate the ratios and interpret the financial statements of the company, right? So here you're going to have in section C, you're going to have 2 questions. Each question is going to carry 20 marks. So this is the whole understanding of your examination pattern that is going to be there. Always remember in section C, guys, there are some topics which are important and which are frequently asked, as I have already told you. One is consolidation. The second one is the individual financial statements. The third one is mostly the ratios that is asked. Okay. So from these 3, always remember that for consolidation, there is always a pattern that they are following, right? There is always a pattern. Usually what students complain about that, oh sir, I did everything in FR in consolidation, but still I could not tally the answer in the examination. That is because they have a pattern that is to be followed and you're supposed to follow that pattern. For example, they have an adjustment for POP, they have an adjustment for fair valuation, they have an adjustment for impairment of the goodwill, or they have an adjustment for the cost of investment. But they will have one adjustment which is new only for that particular sum, which you may have certain problem in. That is because they want you to not only practice and understand the sums that are inside the box, but also think outside the box just for one simple thing. So your ultimate goal for section C is to not actually complete the whole thing and tally it. right? Don't waste your time if it is not tallied. If it is not tallied, maybe check for 5 minutes, 10 minutes, not more than that, because you'll be just wasting your time over that if you're not getting the answer even after checking it for 5 minutes, right? So mostly whatever adjustments you've made, if they are correct, obviously you will be given marks for that, provided that you've completed almost all the adjustments. If one or two adjustments are here and there, or maybe if it is not tallied, maybe because of some certain amounts that are missing, then in such a case, obviously some marks will be cut. But eventually, maybe from a 20 mark, your goal is not to, crack it 20 marks. Just, waste 1 hour on it and crack somehow 20 marks in it. Maybe if you're scoring 16 or 18 for the same thing, it doesn't matter. Don't waste 1 hour there. Okay. Also for your ratios, give more time for ratios, because you're not supposed to just calculate the ratios. You're going to interpret the financial statements. Those who are not fast with typing, FR was actually my first paper. So I was not very fast with typing when I was giving it. Right. So though, I usually had a problem with interpretation of the financial statements. So because you have to type a lot there, you have to provide a lot of information. The more content you provide there, the more marks you score. Right. So for that, keep at least 40 minutes straightway behind for it, right? Because it is the last questions. Usually students are like, oh, it is just ratio calculation. I'll complete it in 15 minutes. But it does not work like that. You have to give 40 minutes for ratios, 40 minutes for your consolidation. That means 1 hour 20 minutes for your section C. For section A, you can give the section A and B, you can give the remaining 1 hour 40 minutes. That is probably 50 minutes for section A and 50 minutes for section B. Okay. If in case your section A is completed sooner, then in such a case, provide more time for section C probably. Okay. Mostly the students complete section A within 45 minutes. So 5 minutes or 10 minutes here and there, whatever is saved, utilize it in section C. If you've provided information of 4 paragraphs for your interpretation of financial statements, provide 5 paragraphs. Okay. Maybe if your content is not so good, okay, if it is not so good, at least they know that you've provided more content and you know a lot about the interpretation. But only the thing is that maybe you're not able to use a good vocab, or maybe you're not able to provide information very appropriately. Okay. So how you're supposed to utilize your time, just keep that in mind. Okay. Then, so the essential topics, as I've already told you, the essential topics that we are going to be covering is nothing but consolidated statement of financial position, consolidated statement of profit or loss. So usually what do they do for your consolidated statement of financial position? It is 5 working notes, 5 base working notes that you're supposed to prepare for FR, right? So it has quite a lot of calculation and also quite a lot of accounting in the consolidated statement of financial position. So they might ask you to prepare the consolidated statement of financial position, right? Or they might ask you to prepare the consolidated statement of profit or loss. But for your profit or loss, you just have 2 working notes, and it is the reason why they might, with that, ask you to calculate the goodwill calculation, right? So these 2 questions could be asked, or also it can be possible that they might ask you both. Prepare the consolidated statement of financial position and the profit or loss. But then there they might have less adjustments because you have to prepare both, right? Both the financial statements, that is P&L, and also your SOFP, right? That is statement of financial position. Then lastly, you will have your interpretation of the company via the ratio analysis that we are doing. It is nothing but the ratios that I was talking about. That also we are going to solve a sum on it. Also, we are going to have a mock paper, and mock paper almost always has this ratio analysis sum, right? So these sums we are going to cover. Also, we are going to cover individual entity calculation. That is nothing but your individual financial statements preparation. So that is not mentioned here because there's just one sum on it that we are solving. Now, what is financial reporting? So I've given you the whole gamut of revision and everything what we are covering here. You might not be knowing many of such things, maybe if you have not started with FR, guys. But if in case, I'm just mentioning, if in case it is not started, be rest assured and be ready to complete your progress as soon as possible, because you have very less time left now. So please start studying. I'm not scaring you all, but I just want you all to clear the examination in the first attempt. Okay, so now talking about what is financial reporting. So in case of financial reporting, guys, if you heard me before, I just said that financial reporting, it is a communication. It is actually an exchange of information through an unspoken language between different entities. Okay, so between different entities who are actually available in the market. Okay, so entities who are listed in the stock exchange. What happens to those entities? They are actually, for example, they want to raise capital. So they might issue shares out in the market. Shareholders will purchase the shares and shareholders will be the owners of the company, right? The directors of the company who are working on behalf of the company, they are actually working on behalf of the shareholders because shareholders are the owners of those equity shares, correct? So shareholders are the owners of the equity shares and directors are nothing but the people who are working on behalf of the shareholders to run the company, to ensure that the company has a profit maximization and with an objective of actually gaining capital growth or gaining wealth for the shareholders who have purchased the shares of the company, right? So if I am a company, I would want to actually attract more shareholders who are not in the company, or keep the shareholders who are in my company attracted, so that my existing shareholders are there in the company, and also the potential shareholders who are interested in the investment in my company, they could actually do so. So for them and also other stakeholders in the market like government, they would check the legality, they would check whether the financial statements have been prepared appropriately or not, right? The suppliers, they would check that the financial statements are correct or not. Maybe they would be concerned about the loan that the company has taken, so that they will think, okay, I've sold certain goods to this company on credit. So the suppliers are thinking, oh, I've sold certain goods to this company on credit, right? So if I have sold these goods on to the company on credit, the company actually should be having the ability to repay the amount, to actually pay me the amount for the goods that have been sold to them on credit. And for those basis, the suppliers, for example, might check the loan taken by the company, what is the debt of the company, and the suppliers might be concerned about whether the company is actually paying to other suppliers on time. If the supplier is an old supplier, then the supplier will check, has the company always paid on time? Maybe say the supplier says that you can pay me after 60 days. So the company shall pay after 60 days, shall not delay to 90 days or 120 days. Then it would create a bad relationship or a bad reputation of the company, and the supplier might not be willing to sell commodities in the future day, right? So the company might have a possibility that in the future date they might have a problem regarding the ability to continue in the foreseeable future their business activities. Okay, now in case of reporting, there is external reporting. So as I told you, external reporting is for the external shareholders who are not part of the company or who are investing in the company, right? Your government or any sort of suppliers or any sort of employees of the company and so on. Internal reporting, on the other hand, is mainly concerned for the management, right? So the management will look at various sectors. Say, for example, it is a company like McDonald's. Like McDonald's has a branch in various locations, right? So whatever revenue that McDonald's takes, that revenue is going to be the total of those locations, right? But through internal reporting, the management, the McDonald's company, the directors might be able to identify, okay, McDonald's location in one particular area, they have generated this much revenue. A location which is in a rural area, they have not generated much revenue. So maybe they can discontinue that part of the operation, or maybe they would want to, change the location and relocate it to some other place where they can generate more economic benefits, right? So that is for the internal reporting for the management to be, very clear that how they are supposed to operate the activities of the company of McDonald's, for example, in different locations. Okay, so that was about external and internal reporting that we are supposed to understand. Whether external or internal, the challenge for the companies is to always create accurate, timely financial reporting in an efficient way. So, in an efficient means whatever are the benefits that they are going to obtain, that shall be able to justify the cost incurred for preparation of the financial statements, right? So, it should be in an efficient manner, firstly, that I explained you. Accurate, that means the financial information provided shall be accurately accounted for and then presented within the financial statements. And also, it should be timely reporting. Otherwise, companies usually have to pay a penalty if in case they do not meet the deadline. Okay. Now, why is financial reporting important and what are the benefits of financial reporting? So, in case of stating why financial reporting is important, you firstly have to consider raising capital. So, if I am a company which is listed in the stock exchange who prepares the financial statements on a yearly basis and presents it to the general public, right? I want to raise capital and I do this so that eventually I can raise capital from the general public. If the people already know of my financial statements, that at what level or what position do I stand, does my company stand, they will be interested in actually investing in my company, right? So if I issue shares or if I issue bonds in the market, right, that would help me raise capital, right? And that is going to be raised by actually shareholders who are interested in my company, who would want to purchase the shares of my company, and they would be interested provided I am giving them information about my financial statements on a yearly basis, right? Then reassurance that the shareholders or people who are investing in my company, they are rest assured that the company is going to have a financial growth, because in the previous years also they might check, oh, in the previous 5 years the company is having a stable financial growth over the period of 5 years. So they are providing reassurance, right? Then any sort of financial analysis, right? So in case of financial analysis, it is just interpretation of the financial information which is provided in the financial statements. That okay, the company has taken this much loan. Okay, the company is paying this much interest on that loan. Okay, the company has these many assets. The company has invested in some shares. The company is receiving some dividends. So understanding the financial cash inflow, cash outflow, expenditures, incomes of the company, and thus understanding the position and the performance of the company through its financial statements, right? Then compliance and law, to ensure that the company is complying with all the laws, all the regulations and the accounting standards in case of preparation of the financial statements, and the government is concerned about the compliance and law of the company, right? Then understanding the benefits of financial reporting, guys. So firstly, we are supposed to identify trends. Okay. What do you mean by identifying trends? That you, for example, are preparing the financial statements from 2010 till today's date, that is 2020. So you will be able to identify, and also the general public who you have shared your financial information with will be able to identify that okay, the company is actually working really well, that it has a stable growth in the profits, it has a stable amount of assets stored so that it can continue in the foreseeable future as well. It has maintained its debt equity ratio, that maybe the debt is not taken too much, right? Because if the company takes too much debt, the company has to pay too much interest, right? And if the company is not able to generate that many profits, interest is a liability that the company has to comply with, right? So then in such a case, they will have to pay it, correct? No matter they earn a profit or not, right? So you can identify such trends within the financial reporting. Then talking about managing cash flow. So obviously, whatever is the cash inflow and outflow of the company, if in case you all have heard of this, financial statements are something which are prepared on an accrual basis. An example of it would be nothing but say that I sold certain goods, right? So if I sold those goods on credit, okay, so I will recognize a sales revenue for it. And the journal entry simply that I will pass is going to be nothing but receivable account debit to sales revenue. Correct? Receivable account debit because I have not received the money and it is my asset, because I have sold the commodity, but I have not received the money for it. Right? So from this receivable, I'm going to get future economic benefits. That means the money out of it. Right? And to sales revenue is credited because it is a sales revenue which is being recognized, right? So sales revenue is recognized, which will increase my profits, but my cash flow is not there because I did not get the cash yet. I do not have a cash inflow. I will receive it in the future date. So there's a difference between the profit that we have calculated and management of the cash flow, right? Because I have recognized it as a sales revenue, which will increase my profit, but my cash flow will remain the amount that it is before the sales revenue, because I've not received the money for that product sold. Okay. So managing cash flow, for that we have a separate accounting, that is statement of cash flows, that I'm not dealing with right now for your YouTube revision sessions. That once maybe you're affiliated with Lakshya for financial reporting, you'll get more clarity on it. Students who are there with Lakshya already, they already know of these concepts. So managing cash flow is also going to be the part or a benefit, or you can say the pros of actually understanding the financial reporting. And lastly, improving business partner relationships. Obviously, if you're paying every time, your suppliers on time, if you're receiving the money on time, so whatever are the business partners, everyone knows in the market that the company is actually preparing the financial statements accurately and appropriately, right? By providing information which is true, fair, right? So here they can be very clear that okay, now this company is doing the business appropriately as per the laws and regulations, so we can maintain good relations with this company, right? So also for improving the business partner relationships, as I said, it is important, right? So in case of financial statements, I've been saying that the company has to prepare the financial statements, has to prepare this, that. What all is inclusive in the preparation of the financial statements? So the things which are inclusive in the preparation of the financial statements are nothing but, in accordance with IAS 1, presentation of financial statements require presentation of the following things. First, statement of financial position that we prepare. So in the statement of financial position, guys, you will have your asset, you will have your liability, you will have your equity, right? In the statement of profit or loss and the statement of other comprehensive income. Now, profit or loss is something that we would have heard of in the previous years also, when we have done a little bit portion of accounting, right? That whatever are the incomes and expenses, or whatever are the yearly expenses and incomes that the company is actually generating, that shall be stated in my P&L, right? So whatever are the yearly operating activities and the sale in the ordinary course of business of the company, or any expenses that the company is incurring in the ordinary course of business, that is going to be stated in my P&L. But OCI, that other comprehensive income, which is known as OCI, right? That is a statement which is prepared separately. It could be prepared separately after your statement of profit or loss, or it could be prepared below your statement of profit or loss just by stating OCI, and below that you can state it, right? So what will be inclusive within OCI? Things which are not related to the operating activities of the company, but is a gain to the company, right? So for example, the company is actually revaluing its asset. Maybe the company was holding its asset as at its historical cost. Okay, maybe the asset had, the company purchased the asset 5 years ago. At that time, the asset had a value of $1,000, and maybe the company thought that okay, I'm going to use this asset in my business for a period of 5 years, right? So accordingly, we apply the concept of depreciation and charge depreciation maybe on an SLM basis here. It is going to be 1,000 divided by 5 years useful life. That is 200 depreciation charged each year, right? But after 2 years, so probably my carrying value after 2 years is nothing but $1,000 minus $200 depreciation for the first year, minus $200 depreciation for the second year. That means 1,000 minus 400, which is going to give me 600, right? So 600 is nothing but the carrying value of my asset. But if I go out in the market and check the market value of my asset, maybe it is $800. That means in the market, if I go and sell this asset, I will receive $800. So this asset is going to give me future economic benefits of $800. Then why would I state it at a lower amount, that is $600? I will actually reevaluate this asset's value as per the IAS 16 revaluation model and state it at $800. Now this is a gain that I got of $200. Now this is a hypothetical situation that I am intending to sell my asset and calculating its up-to-date value out in the market right now. Okay, so this is not an actual cash inflow that I'm getting, or this is not an actual gain which is relating to my operating activities, right? So this cannot go in my P&L because revaluation is not like a part of my operating activities, a part of my ordinary course of business. It is going to be a part of my investing activities, or you can just say related, which is not related to the operating activities and will not go to P&L. So it is going to be stated in other comprehensive income, which is nothing but the owner's equity which is stored for their particular assets, right? Then you have your statement of changes in equity. So guys, in case of statement of changes in equity, firstly, what are the components of equity? You will have your share capital, which is issued in the market. If it is issued at a higher value as compared to its nominal value, that is, for example, $1, but I issued it for $2.5 because that was the original market value, right? So then share premium will also be there. Maybe say there is a revaluation surplus. What is that? Because it is going to be a part of other comprehensive income. So the example that I gave you, the assets value is $600, but its market value is $800. That means the difference of $200, that is an increase in the value of the asset, right? So that increase in the value of the asset is going to be nothing but asset account debit, because debiting means increasing the value of the asset, to OCI, I mean to your revaluation surplus, which will go to your OCI, that is $200. So that is a revaluation surplus, which is also going to be a part of your other components of equity, right? Then you have your retained earnings, which will include the previously stored profit and also the current year profit that is there. Okay, it will probably be subtracted by any sort of dividends which are already paid out by the company. Then you have statement of cash flows. So as I told you, the profit that you calculate, that is calculated on an accrual basis. So that doesn't mean that the profit is equated with the cash. If, for example, you have a profit of 1 lakh, that doesn't mean you have a cash of 1 lakh. Probably you have a cash lower than that. So maybe say the cash is $30,000. So for the calculation of cash in hand, you have to calculate the statement of cash flows. You have to understand the statement of cash flows, which is also a part of your FR, but which is not mainly asked for your section C or not frequently asked for section C, and is the reason why we are not dealing with it right now. If you get affiliated with Lakshya for FR or for any other subject, you're going to get clarity for everything, because here in the YouTube revision sessions, we are not going to be able to cover each and everything, right? And lastly, the thing which is a component of the preparation of financial statements is nothing but the explanatory or disclosure notes, that are the notes provided to the financial statements. So we assume that all those who are users of the financial statements, or who are actually, going through the financial statements, are not chartered accountants or ACCAs who would understand the whole financial statements, right? So for getting clarity, or for, providing clarity to the users of the financial statements, there are certain notes which are actually stated that, for example, I purchased an asset. So whatever is the purchase invoice will be stated that, the asset is actually capitalized at a value of 1 lakh, because in the disclosure notes it will be mentioned that this is the purchase invoice of the asset which is purchased for 1 lakh, and it is same valued for 1 lakh. Okay, so asset has been purchased and cash has been gone out, and for that information is provided in the disclosure notes. This was just an example that there could be disclosure note for many things. Okay, especially for the accounting policies that the companies adopt. Okay, for the preparation of the financial statements. Now, with this, guys, we are done with the introduction to financial reporting. Now, I'm not going to be dealing with the basics of financial reporting or anything as such. We are going to be start with the solving, or not means the solving. Maybe we are going to start with firstly the conceptual clarity on the consolidated statement of financial position and the consolidated statement of profit or loss. Then on, I will show you how you're supposed to give the test on the computer-based platform, that is computer-based exam platform, CBE platform, and also how you're supposed to get access to the study resources, which is made available by the ACCA itself. That is nothing but the ACCA Study Hub. So once before starting off with our conceptual clarity, we'll just take a break of 10 minutes, after which we are going to be rewinding with our start, or with our head start towards our consolidated statement of financial position, and then consolidated statement of profit or loss. So let's just have a break of 10 minutes, after which we are going to be continuing with the latter part. Thank you, guys. Hello everyone. I hope we are all back from the break. Now we are going to head on towards our chapter that we are supposed to cover, mainly which is associated with the consolidation. That is nothing but consolidated statement of financial position and statement of profit or loss and other comprehensive income. So for your consolidation, guys, you're going to have both the financial, both the components of financial statements, that is preparation of the consolidated statement of financial position and consolidated P&L and OCI to get clarity on your consolidated concept, and when asked for an examination to be very much clear with everything so that you can solve the sum very fluently and very easily, right? Now, firstly, let us understand what is the basic principle of consolidated statement of financial position, right? So we are going to head on first with the consolidated statement of financial position, then move towards the consolidated statement of profit or loss, right? So the basic principle of a consolidated statement of financial position is that it shows all assets and liabilities of the parent and subsidiary. Inter-group items are excluded. Example, any receivables and payables shown in the consolidated statement of financial position. It will only include amounts owed from or to third parties. Right? Before understanding this, I would just like to make certain things clear to everyone. Just a second, guys. I'll just increase the size a little bit. Okay. Now, your consolidated statement of financial position, correct? For your consolidated statement of financial position and P&L, firstly, I will make you understand what is consolidation, right? So, consolidation is nothing but another name for it is business combination, right? Now, wherein there is one company, maybe say A company, okay? And there is another company which is, say, for example, B company. If A company has purchased shares in B company, right? From maybe say 100% shares of B company, out of that, maybe say A company has purchased all the 100% shares of B company, right? So that means A company has completely purchased B company, correct? That could be many reasons for it being, purchasing this company. Like for example, A B company is a competitor of A company, and A company wants to eliminate its competition. Or B company has a very good competitive position out in the market, and also a brand loyalty is there for the customers. And B company is a well established brand probably. So because of which A company is going to get a lot of synergies, or you can say benefits, from purchasing B company, right? So A company thus purchases B company because of the various synergies that they're going to receive on this business combination, right? So that means A company, if has purchased B company, A company has control over B company, right? A company has control over B company. So here, guys, A company is known as the parent company, right? For the sake of simplicity, let me just name them as P company, and the company which is acquired by P company name as S company, right? So that the name is also suggesting the parent and the subsidiary relationship. Okay. So A company is known as the parent company, right? Because it is the company which has acquired another company. And B company, oh sorry, S company, here also I'll change it. And S company is known as nothing but the subsidiary company. Okay. So A company here, guys, is known as the parent company, whereas the company which has been acquired, right, is going to be known as the subsidiary company. Okay. And for this parent subsidiary relationship, we prepare the consolidated financial statements. Okay. For this parent subsidiary relationship, we are preparing our consolidated financial statements. Now, here in case of consolidated financial statements, what is the concept we are applying? it is the single entity concept that we are applying. It is a single entity concept that is applied here. That means the application of single entity concept states that the parent company and subsidiary company are together a single entity, and this single entity concept is known as nothing but group. Okay, so together they are a group of two entities and they are considered as a single entity, right? So that means two companies, that is the parent and subsidiary company, are considered as a single entity, guys. So if they are considered as a single entity, that means in such a case I will have to add up all the assets, liabilities, and equity of both the companies. Correct? I will have to add up all the assets, liabilities, and equity of both the company. Maybe say when you prepare the consolidated statement of financial position. So in that maybe you will have your non-current assets. In that maybe you have a property, plant, and equipment. That will be stated for the parent company and for the subsidiary company. So maybe say under the head non-current asset, the property, plant, and equipment. Maybe they have a building. Okay, the building value of parent company is 1000 and of subsidiary company it is 750. So under consolidated financial statements, the consolidated statement of financial position, under the head non-current assets, there will be property, plant, and equipment, which will be stated at a complete value, which is nothing but the sum of these two or an addition of these two, that is 1000 plus 750, which is going to give us 1750. We are adding up their assets, liabilities, and equity to show that the parent company has control over the subsidiary company and they both are considered as a single entity under the head group. Okay, so this is the group. Are you all clear with this part, that what is the base to consolidation and how it is treated within our financial statements? Just repeating quickly this part. Parent company has control over the subsidiary company, maybe because it has purchased 100% of the company, and the parent company is known as, I'll just write here parent company, right? Parent company is the company which has acquired a subsidiary company, and the subsidiary company is the company which has been acquired by the parent company, right? And when there is a parent subsidiary relationship like this, we prepare the consolidated financial statements, and the consolidated financial statements are prepared on the basis of single entity concept, right? Which states that the parent company and subsidiary company are together a single entity and together they are known as a group. Okay, so under the single entity concept, we are just going to add up all the assets, liabilities, and equity for the parent and the subsidiary company. Also, in the statement of profit or loss, our revenue and cost of sales will also be added. But right now, I'm just dealing with the consolidated statement of financial position and thus just talking about the assets, liabilities, and equity. Right now, for identifying control over the subsidiary company, it's not that the parent company should have 100% control or 100% purchase of the subsidiary company. Anything which is above 50% till 100%, it is known as control over subsidiary company. Okay. Now, what does this mean is that if the subsidiary company, for example, has 2000 shares out in the market, okay, if the subsidiary company, for example, has 2000 shares out in the market, out of which the parent company has purchased 1600 shares of the subsidiary company. Okay, the parent company has purchased 1600 shares of the subsidiary company. That means how much percentage of the company is the parent owning? It will be nothing but 1600, which is the shares that they have owned, divide by 2000, which is the total number of shares of subsidiary, into 100. So you will get it in percentage. That means 80% of the subsidiary company's shares are owned by the parent company. That means it is above 50%. So that means parent company has control over subsidiary company. So we will prepare the consolidated financial statements. The only difference here is that the subsidiary company that is there, it is not a wholly owned subsidiary company. It is a partly owned subsidiary company because we own 80% and the remaining 20% that is there, that is not under our control. So that will be nothing but known as non-controlling interest. Okay, that means the interest within the company which is not under our control, right? So here 80% of the subsidiary company is within our control, but the remaining 20% is not within our control because it is a partly owned subsidiary company. I'm so sorry, guys. I hope this concept till here is clear to you all. This was your partly owned subsidiary company. That is, whenever we have a percentage which is above 50%, control over subsidiary companies determined, and thus consolidated financial statements are prepared. Okay. Now, as we saw just now, that above 50%, if I am owning above 50% up to 100%, I am technically having control, and thus I will prepare a consolidated financial statements, right? If in case it is below 50% or maybe 50%, right? Maybe it is 20% to 50%, right? This represents that I do not have the complete control over that company, but I do have certain influence in that company. Maybe say the company is taking a decision, of paying dividends to its shareholders. I am saying that no, the company should not pay the dividends to the shareholders because the company has very less retained earnings and the company will end up having less retained earnings if it is paying out dividends to its shareholders. So my decision, if I, for example, I am owning 30% of the company, right? If I am having 30% of the shares of the company, if I say no, that means 30% of the vote says that no, the dividend shall not be paid to the shareholders. That means technically I have certain influence over that company. So this represents significant influence. That means if I have a shareholding, a percentage shareholding above 20%, but 20% or above 20% or 50% or below 50%, then in such a case, it represents that the company is my associate company. Okay. I am the parent company. Okay. And the company that I am owning 20% to 50% shareholding in is going to be known as my associate company. So here it is not a parent subsidiary relationship. It is a parent associate relationship. So here they are not considered as a part of the group. The associate company is not considered as a part of the group. And for this, consolidation is not going to be done. Consolidation is also not going to be done. The only thing that is going to be done here is nothing but your equity method of accounting. That is nothing but we are not adding up the assets and liabilities of the associate company. We will just prepare certain separate working notes that are prepared for the associate, and that we are not dealing with right now. I'm just giving you a glimpse of it. Okay. And if in case, if it is below 20% shareholding, if it is below 20% shareholding, then it is normally known as an investment in a company. And if you remember financial instruments, and investment in a company is known as nothing but your financial asset because you're going to generate future economic benefits from the investment in the company, probably in the form of dividend being received because you, for example, purchase the shares of the company, right? Or for example, in the form of capital growth that you receive, right? So this is going to be treated as a financial asset under the, and for this, whatever is the portion covered, it is covered under the chapter financial instruments. Right? Now guys, we are clear with this part. Let's see, if it is above 50% till 100%, we have control over the subsidiary company. So we are going to prepare the consolidated financial statements. If we have less than 50% or 50% shareholding in the company, we are going to consider this as significant influence over the company, right? This mentioned here, significant influence over the subsidiary company, and it is going to be 20% to 50%, right? Then we do not consolidate here, no consolidation, and only associate relationship is to be stated. That is going to be done through equity method of accounting, and associate is not going to be a part of the group, neither is consolidation going to be applying here. Okay, then lastly, if it is below 20%, it is going to be normally treated as a financial asset because it is an investment in the company. Below 20%, we do not even have a significant influence here. And thus, for this information will be received from the financial instruments chapter. Okay. So I hope the whole understanding, the whole base of consolidation is clear to you all. Always remember guys that control over the company, over the subsidiary company is not always determined by the percentage shareholding in it. Maybe it can also be determined, maybe say I have the control of actually appointing five directors in the board out of the total seven. That means I have more than 50% appointment rights to actually appoint five board of directors, right? So out of maybe say 3.5 board of directors is 50%, but I can appoint five board directors. That means I have more than 50% control in case of appointment of the board of directors. I may also have certain options or forward contracts which could determine my control over the company, but those are all just for conceptual clarity. These are not considered for your consolidation. For consolidation, if you want to identify the control over the subsidiary company, the only thing that you're supposed to rely on is nothing but the percentage shareholding in the company. This is done by ACCA for the sake of simplicity in identifying the control over the subsidiary company. Okay. So I hope this whole base to the consolidation is clear to you all. Now we'll head towards the syllabus that we are supposed to consider through the PPTs, right? So now first thing is nothing but intra-group items are excluded. Example, receivables and payables shown in the consolidated statement of financial position only include amounts that owed from or to the third parties. Now what they are trying to say here guys is that, say for example, there is a parent company, okay, and there is a subsidiary company, right? Now parent company maybe, for example, has sold certain goods on credit to subsidiary company. Okay. Parent company has sold certain goods on credit to subsidiary company. Now, for parent company, in the parent company's individual financial statements, they will state receivable, right? Because they have sold the goods and for that they are supposed to receive an amount, right? Receivable, and their receivable is nothing but S company. On the other hand, in the financial statements, in the individual financial statements of S company, they will consider a payable which is a current liability for them. That is nothing but the parent company because they purchase the goods on credit from the parent company and then and now they are liable to pay for it, right? So when this is a receivable for one entity and a payable for another, right? So when we prepare the consolidated financial statements, we assume that it is a single entity, the parent and the subsidiary together, right? So a single entity cannot trade within itself and have a receivable and payable for itself. So obviously when we consolidate, it is an intra-group transaction because they are a part of the group, the parent and the subsidiary. It is an intra-group transaction, and these current accounts that are there, that is current asset for one entity, right? That is a receivable, and a current liability for another, that is a payable, that shall be eliminated, right? Eliminated from the consolidated financial statements, right? Consolidated statement of financial position. That is what they are explaining because we assume that this is a single entity. So I cannot sell to myself and purchase from myself, correct? So since it is a single entity, I cannot create a receivable and a payable amongst myself, and thus I am going to eliminate or maybe say extract these two and remove it from my financial statements. Okay. So this is just an example of the intra-group that we are supposed to understand. Okay. Now let's get ahead with the method of preparing consolidated statement of financial position. The investment in the subsidiary company, which is shown in the parent company's statement of financial position, is replaced by the net assets of subsidiary company. Now, what they are trying to say here, again, I'm going to explain you. Say, for example, that the parent company has purchased 100% of subsidiary company. Okay. And parent company, for the purchase of subsidiary company, has paid a purchase consideration maybe of $20,000. Okay. They have made a payment of $20,000. Okay. Now the subsidiary company, maybe they are net assets. Now what is their net assets? Their net assets is nothing but whatever is the share capital issued by the subsidiary company, whatever as the retained earnings to date of the subsidiary company, and whatever is, for example, there is a share premium of the subsidiary company. Okay. These are all the net assets of the subsidiary company at the date of acquisition. So at the date when the parent company is purchasing the subsidiary company. So maybe say, for example, that the share capital of the subsidiary company is 3,000, right? The retained earnings to date are 4,000, right? And the share premium is nothing but 1,500. So when we are actually paying 20,000 for this, you can see that maybe the net assets of the subsidiary company is nothing but 3,000 plus 4,000 plus 1,500, 8,500. That means when we are purchasing the subsidiary company, the assets that we are receiving is only worth 8,500. But the amount that we are paying for it is nothing but $20,000. So we are paying an amount as a parent company, we are paying an amount which is over and above the subsidiaries company's net assets, right? And always remember, these are not just net assets. You have to consider the fair value of these net assets so that you can identify the up-to-date value of the assets of the subsidiary that you have acquired. Okay, so these are just not net assets. I will just mention here fair value of net assets. Okay, so here I have paid something which is over and above the value of the net assets that I have acquired. So why have I done that? Probably because the subsidiary company was already in existence in the market. They had very good food products. Maybe it is a food product or a food manufacturing entity, for example. They have their fruit products which have a very competitive position out in the market. It is very famous. The customers really like it. The customers have loyalty towards the food products for the purchase of it. Maybe they have a very competitive position out in the market. Maybe they have brand loyalty. They have their assets. Like for example, they have certain intangible assets like copyrights or patents for, particularly selling certain food product, which is very different, right? So those are all the benefits that the parent company is going to receive when they purchase subsidiary company. So the subsidiary company says that 8,500 I know is the value of my asset today. But I want more than that because in the future date, when you purchase me, you're going to get a lot of synergies or a lot of benefits by actually purchasing me because I have a lot of customers which you're going to get. I have a competitive position that you're going to get. So I need something which is over and above this amount of 8,500, right? And is the reason why we pay certain amount which is over and above the fair value of the net assets, which is $20,000 paid here. So the purchase consideration that we have made here for acquiring this subsidiary, purchase consideration made here for acquiring this subsidiary is nothing but 20,000, and the net assets that we have acquired, right? Of the subsidiary, the fair value of the net assets that we have acquired are maybe say, sorry, it's here only, right? That is 8,500. That means I will just state here negative amount to identify the amount that I have paid over and above, right? So that amount which is paid over and above is nothing but goodwill. Okay. That is nothing but 20,000 minus 8,500, which is 11,500. So by purchasing this company at a value $20,000, I've put a value to the company in the market, that this company is worth $20,000 is the reason why I purchased it. And this goodwill that I've paid amount, this amount that I've paid, that is over and above the fair value of the net assets of subsidiary that I've acquired, right? Of subsidiary company at acquisition, right? Whatever is their fair value at acquisition that I've acquired, I've paid an amount over that is known as my goodwill. So this goodwill is nothing but known as the goodwill acquired in a business combination, right? I have acquired this goodwill only because I purchased this company, right? So this, I've put a fixed value to this. So this goodwill is going to be recognized in my financial statements under the head, in my statement of financial position to be exact, under the head non-current assets. Okay. Why? Because a non-current asset or a current asset is any asset which is going to bring me future economic benefits, right? In the form of maybe say cash or any other form, right? So it is going to bring me future economic benefits. And obviously I purchased a company, so it is going to bring me future economic benefits is the reason why I've paid an amount over and above the company's value that I acquired, the company's net assets that I've acquired. So this will be recognized as a non-current asset within my financial statements. So that is my goodwill understanding. So this is what I've made you understand, that here there could be also goodwill that we are acquiring. And coming back to the point which was stated in the PPT, the investment in the subsidiary shown in the parent statement of financial position is actually replaced by the net assets of S. So maybe say when you prepare the consolidated statement of financial position, maybe say they've given you the base, consolidated statement of financial position. In that you will have the head firstly non-current assets. In that probably you will have investment in subsidiary company at cost, right? You paid for it how much? 20,000, correct? 20,000 you paid for it. Then this is the parent company, correct? I'll just mention here parent company and the subsidiary company, right? For parent company, it is going to be an investment in the subsidiary company in the non-current assets because it is going to bring them future economic benefits. But in the equity, guys, what will be mentioned? Equity, the share capital of the subsidiary company, the share premium of the subsidiary company, the retained earnings of the subsidiary company are all going to be here, right? That is nothing but 3,000. Retained earnings are nothing but 4,000. And share premium is nothing but 1,500, right? So when we are consolidating, we will eliminate this. We will eliminate this amount because it is nothing but an investment in the subsidiary company, and under consolidation we assume that subsidiary and parent are a single entity, so I cannot invest in my own company itself. So investment in subsidiary company at cost will be eliminated completely, and also these three components that are there, these three components will also be eliminated completely because these are the components that I've acquired, right? These are the components that I've acquired. So these three are also going to be completely eliminated. Okay. Now, these retained earnings that are there, this is at the acquisition period, right guys? These retained earnings that are available, they are at the acquisition period. So these retained earnings, I'm so sorry guys, these retained earnings of the subsidiary company are available at the acquisition period. That means these are the retained earnings which are actually generated or actually earned by the subsidiary company before it was acquired by the parent company. So this they have owned by their own hard work. So this we are not going to take a share of this part, right? And thus it is included within the goodwill calculation that I'll show you when we come across the working group, right? So right now we are just going to keep this in mind, that the investment in S at cost and these values are going to be cancelled when we prepare the consolidated statement of financial position. Okay, because then this is going to be like investment in the subsidiary company. That means I'm investing in myself and my shares are also mentioned here. Okay, so these two things will be cancelled when we prepare the consolidated statement of financial position. I hope you all are clear with this part of the concept. Now, the cost of investment in S is effectively cancelled with the ordinary share capital and reserves of the subsidiary company, leaving goodwill as a balance. So this concept I've already explained you that whatever is the cost of investment in S, that is subtracted by the fair value of the net assets that has been acquired of the subsidiary company, and the remaining will be nothing but the goodwill which is to be stated, right? Only of the subsidiary company, the share capital and all will be cancelled, right? The share capital, share premium, and retained earnings, provided that these are available at the date of acquisition, right? If there are any retained earnings that the subsidiary company has owned, maybe say 31st, maybe say 1st Jan 2003, I've acquired the subsidiary company, right? And on that date, the retained earnings, that means the complete profit of the subsidiary till that date, was nothing but this 4,000 which is stated. That means I do not gain ownership on this. This will be a part of my goodwill, how that I'll make you understand. But I technically right now do not have ownership on this because this the subsidiary they have earned by themselves. I did not acquire them when they were earning this retained earnings of 4,000. I acquired them today, right? So these are pre-acquisition profits which are available of the subsidiary. So we do not have ownership of this. But at the year end, maybe say at 31st Jan 2003, maybe say the retained earnings have increased from 4,000 to 7,500. Okay, so that means I have acquired the subsidiary on 1st Jan, after which its profits increased by to 7,500. That means the retained earnings in the post acquisition period, that means the period after which I've acquired the subsidiary company, has increased by nothing but 7,500 minus 4,000, which is nothing but 3,500. So these are the retained earnings that has been generated after I've acquired the subsidiary company. So I can be entitled for the profit share, right? Because I have acquired the subsidiary company, correct? Right. So this 3,500 will then belong to me, provided that I am owning 100% of the subsidiary company. If in case I am owning 80% of the subsidiary company, right? 80% of this will go to the group, that is nothing but me, and 80% the parent company, and 80% of the subsidiary company owned, right? So 80% of the subsidiary company's profit will go to the group. And if the remaining 20% is there, which I do not own, that is nothing but the non-controlling interest, to them 20% of this will go, that is 3,500 into 20 divided by 100, right? So this is how you're going to share it. How you're going to do it and whole process, we are going to understand it through the working notes. So now I think the base concept is clear to everyone. We'll just get started with the method of preparing it. Okay. If in case it is not clear till now, guys, no worries. When we are dealing with the working notes of each and every one of them at once, so like one by one, at that time you will get more clarity on this. So let us understand the method of preparing consolidated statement of financial position. This produces a consolidated statement of financial position showing the net assets of the whole group, that is nothing but the parent plus the subsidiary. As I told you, you have to add all the assets, all the equities and all the liabilities. So just we are going to do the same thing in the method of preparing the consolidated statement of financial position. Then comes the share capital of the group, which always equals to the share capital of P only, right? That means maybe the share capital of the group, which equals to the share capital of P only, and the retained earnings comprises of profits earned by the group, that is the P's historical profits plus the post acquisition profits made by S. So it is nothing but whatever they're trying to say, you will probably understand through a working note. So let us look at the working note before dealing with the concept which is discussed here. Okay. Now, so always remember, guys, for your consolidated statement of financial position, as I've already told you, you have to prepare 5 working notes. Okay, you have to prepare 5 working notes. It is to be presented separately to show that the financial information, that the financial statements that you've prepared, that you've presented, where are the values in that coming from? Okay, so you have to prepare the working notes. It is mandatory. Please don't just directly solve the sum and calculate the working notes on pen and paper or maybe in your mind. You have to present it because it will show the presentation that where are you actually getting the values from. Okay, so the first working note in case of preparation of the consolidated financial statements is nothing but establish the group structure. Okay, so if for example the parent company has acquired the subsidiary company, so you will state the parent company dash has acquired the subsidiary company. They have acquired 80%, maybe for example they've acquired 80% of the company, and you will mention the date on which it was acquired. Right? This indicates that P company owns 80% of the ordinary shares of S company and when they were acquired, right? So it is representing how much percentage of the subsidiary company do I have a control over or have I owned, and on what date have I purchased this company. Okay, so how much of the subsidiary is owned and how long has we are having the control over the subsidiary company. This is very useful for you if in case you want to calculate certain amounts in your financial statement. So you don't need to go through the question again. You've just prepared the working note. Just look there quickly. Working note 1, what is the group structure, and then accordingly do the sum. So let us understand working note 1 quickly first. Working note 1 is going to be prepared, which will be nothing but group structure. Okay. In the group structure, you will just mention, maybe say the parent company, whatever is the parent company name. Maybe say the parent company name is Paris company. Okay, so the Paris company has acquired Saturn company. Okay, that is the subsidiary company. Maybe they have acquired 85% of the subsidiary company. So you can mention like this, and maybe you can mention the date. The date of acquisition, maybe they've acquired on 1st Jan 2022. Okay, so this is how you're going to mention the first working note. That is nothing but the Paris company has acquired the Saturn company, right? The Paris company is the parent company and Saturn company is the subsidiary company. You don't need to mention whether which is the parent and all that, because obviously 85% represents, so the examiners will be it will be very much understandable for them that this is the parent and this is the subsidiary. Okay, and the date of acquisition shall be mentioned. Now you are supposed to calculate the working note 2, that is nothing but the net assets of subsidiary company, right? In case of net assets of the subsidiary company, you will have to calculate 3 columns. You have to make 3 columns. At acquisition, I'm just writing at ACQ for acquisition. Then at the reporting date, right? And lastly, the post acquisition. I'm just writing post ACQ, right? So now it is only of the subsidiary, guys. Only the net assets of the subsidiary you're supposed to calculate, right? So let us just look at the working note 2. So the working note 2 is nothing but, as I told you, at the date of acquisition, at reporting date, and at the post acquisition, right? So firstly, you will have your share capital, then any sort of reserves that like share premium, retained earnings, and revaluation surplus shall be considered, right? So what we will do is whatever is the share capital, right? Maybe say the subsidiary share capital was 20,000 shares were issued in the market, right? So it won't change at the reporting date, it will remain the same, right? So 20,000, 20,000. The share premium, right? At the date of acquisition, maybe I acquired the company on 1st Jan and the reporting date is 31st December 2022. Okay, so the reporting date for the period of 1 year, are there any changes or not that you're supposed to state? Okay, so it is 20,000 here, 20,000 here. So in the post acquisition, there is no changes. So I'm just leaving it blank. Then share premium, maybe this is also the same, 3,000, 3,000. Okay, so I'm leaving it blank because there are no changes. So there are no post acquisition profits or losses. Okay, then maybe retained earnings. They would probably mention in the question that maybe say at the date of acquisition, at acquisition, the retained earnings of the company or the subsidiary company is maybe say 20,000, or I'll just take another amount. Maybe say it is 13,000. Okay. So that means this is the 13,000, which is a pre-acquisition retained earnings. And since it is a pre-acquisition retained earnings, we do not have actually an entitlement to receive this amount, correct? And maybe say this was on 1st Jan, right? At the date of acquisition, that means this was on 1st Jan 2022, correct? By 31st December 2022, maybe the retained earnings got increased to 15,000, right? That means after the acquiring of the subsidiary company, my retained earnings of the subsidiary company I have increased from 13 to 15,000. So whatever is the increase, that is of 2,000 here, that will be entitled to me, but not the whole. Here, if for example I have acquired only 85% of the company, 85% will belong to me, and the remaining 15% will belong to NCI. Right, guys? So here, the retained earnings, as I've mentioned here, I'll just take the same one, 13,000 and 15,000. Right? 13,000, and here it has become 15,000. That means there is an increase. So 15,000 minus 13,000, which is going to be 2,000, which is the post-acquisition profits increase. Right? Then, revaluation surplus. So if in case I've revalued a particular asset, so if I've revalued it, the asset, right? At the date of acquisition, right? Only at the date of acquisition. Then in such a case, whatever is the revaluation surplus will be stated here. But if it is post acquisition, I've done a revaluation of the asset, then it will directly go to my OCI. Okay. How it will go and what will be the journal entry, that we'll understand later on when we come across this concept. Okay. Now, as of now, we are clear with this part. That is your working note 2 that we are supposed to prepare. Right? So your post-acquisition profits are nothing but 2,000 that we have calculated. This will be distributed amongst the group, right? And the NCI, right? So subsidiary group is owning 85% of the subsidiary company, and NCI is owning the remaining 15%, right? So if 2,000 is the profit, 2,000 into group is owning 85%, so 85 divided by 100. 1,700 will go to the group, and to the NCI the remaining 300 will go, that is 2,000 into 15%, right? That is going to be 300. So 1,700 belongs to the group and 300 belongs to the NCI. Okay, where it will be adjusted, I'll show you. Okay, as of now I'm just mentioning, that it will be adjusted in working note 5. This will be adjusted, and this will be adjusted in working note 4. Okay, how it will be adjusted you will understand when we once we come across working note 4 and 5. Okay, then the next working note that we are preparing is nothing but working note 3, which is nothing but the calculation of goodwill. Okay, so when does goodwill come into consideration? Goodwill always comes into consideration when you have paid extra, right? So maybe the assets that you've acquired, the fair value of the net assets that you've acquired is maybe say 10,000, but you have paid 15,000 for it. So that time the goodwill comes into consideration, right? So the parent company, the parent holding investment at fair value. So whatever is the parent holding investment at fair value, or whatever is the purchase consideration given by the parent, that will be paid here. Okay. So say for example that the parent company has paid $15,000 for acquiring 70% of the subsidiary company. So in the goodwill, the first thing that will be stated is nothing but purchase consideration. Right? Whatever purchase I've made or whatever is the cost of investment, it is the same thing. Okay. So that will be nothing but what is the amount I've paid? I've paid 15,000. So that will be stated as 15,000. Now, I have paid 15,000 for acquiring how much percentage of the company? For acquiring 70% of the company. That means 15,000 represents 70%. So what about the rest 30%? So the rest 30% will be my NCI. NCI will be calculated at fair value or proportion of net assets method. Right? What is that? You will understand later. Okay. So maybe my NCI at fair value or proportion method is maybe say 3,000. Okay. It will be added to my purchase consideration because this represents 70% and the NCI represents the remaining 30%. Right. So that becomes the complete 100%. Okay. So now NCI will be added to my purchase consideration, and from that, whatever are the net assets of subsidiary company have acquired at the date of acquisition shall be deducted. So maybe say the net assets of the subsidiary company that I've acquired. See, you can see here the net assets that I acquired is 13,000, right? At the date of acquisition, it is 13,000. So that means I've purchased their share capital, purchased their share premium, and all of their pre-acquisition retained earnings is the reason why I'm deducting it from here. Okay, so I will deduct this 13,000 from here, and thus the goodwill amount that I will get is nothing but 15,000 plus 3,000 minus 13,000, which is going to be nothing but 5,000. Okay. Now, just mentioning one thing, why are we doing this? Is that, see, now when we are consolidating, okay, when we are preparing the consolidated financial statements, maybe statement of financial position, maybe the parent company in this example is owning 70% of the subsidiary company. Okay. But when we are doing the consolidation, maybe say there is non-current assets under which I have property, plant and equipment of the parent company and also of the subsidiary company. Okay. Maybe the property, plant and equipment value is 1200 and 1400. Okay. So when I'm preparing the consolidated statement of financial position, I am just adding these two, right? Just a second. I'm just adding these two, correct? That means I'll add the property, plant and equipment of both 1200 plus the whole 1400 of the subsidiary company, right? Even though I've acquired only 70% of the subsidiary company, I cannot take 70% of this like that. Like I cannot take 70% of the assets suddenly. Okay, I have to take the whole subsidiary company's assets. Okay, so if my asset also includes that 30%, okay, it includes that 30% of the NCI that is not within my control, that is not owned by me. It includes that 30% as well, correct? So it should be balanced out somewhere because I should have included 70%, but I'm including 100% of the subsidiary company's assets. So it will be balanced out in the equity. In the equity, you will state non-controlling interest, which will be calculated and which will be the remaining 30%. So your asset 30% extra will be nullified with the equity 30%, which is stated here. It will not be cancelled, but it will be valid for calculation of the statement of financial position consolidated. Okay. So this will represent the remaining 30%. So it will be stated in your equity and your property, plant and equipment. That is your assets. Okay. That is the reason why we actually take the total net assets. That is the 100% of the subsidiary. So we have to also take the 100%. So we are taking 100% of the subsidiary's net assets. So we have to also calculate 100% of the purchase that we've made. So that is 70% representing this amount that we've paid, and the remaining will be NCI, which is 30%, right? So completely for acquiring this company, the total value is 18,000. But the net assets that we received for actually purchasing this company is 13,000. And thus the amount which we paid over and above the net assets that we've acquired is nothing but 5,000. I'm hoping everyone is clear with the concept of goodwill. Okay. Lastly, in case of goodwill, I just forgot to mention one thing, that is nothing but impairment. Okay. I have acquired the subsidiary company, which is, I've paid maybe say here 15,000 is written. So I've paid 15,000 for acquiring this company. maybe because the company had a very good competitive position out in the market. But after that, I acquired the company, maybe I am not able to handle that company value now. Okay, is the reason why probably the company's market value has gone down. Okay, so that means if the company's market value is going down, that means my goodwill is being affected, right? Because the company's worth was 15,000, right? But maybe now its worth is 14,000, correct? So that means my goodwill has lost by 1,000. So if there is a goodwill impairment of 1,000, that will be deducted. Impairment clarity on this topic must have already been done in IAS 36. So I'm not dealing into the details of this topic. I'm not getting into the details of it. So we are just going to get the goodwill here after impairment, which is nothing but 4,000, right? So thus we will calculate this goodwill and this will be stated in the statement of financial position. So that was all the calculation that was supposed to be done for your goodwill. Now we'll jump to working note 5. So, sorry, working note 4, not working note 5. That is nothing but non-controlling interest. Now, non-controlling interest, again, guys, is a very important topic which includes two methods of calculating non-controlling interest. That is nothing but first, which is the fair value method, right? You can see here NCI value is equal to fair value of the NCI's holding at acquisition, which is nothing but number of shares which NCI owns multiplied by the subsidiary share price. And the second one is if the proportion of net assets method is adopted, that means nothing but NCI percentage into the fair value of net assets at acquisition, right? So how will I calculate these two NCIs? I'll just explain you. Maybe say, firstly, I'll just state working note 4 we are solving, in which case NCI maybe at fair value is there. Okay. So how to calculate NCI at fair value? Maybe the parent company acquired 80% of subsidiary company, the total shares of 5,000. Okay. So the total shares of subsidiary company is 5,000 shares, right? And parent company has acquired 80% of the subsidiaries 5,000 shares, correct? Maybe the subsidiary company's share price at the date of acquisition is nothing but maybe say $3. Okay, each share had a value of $3 at the date of acquisition, but that is only the subsidiary share price. Okay, always keep that in mind. So how will we calculate NCI at fair value here? Okay, it will be calculated as 80% is purchased by the parent company, right? Right. That means 20% is with NCI, correct? So out of these 5,000 shares, 20% is with NCI. So that is how many shares? 5,000 into 20 divided by 100,000 shares, right? And for each share, what is the value of each share? $3. So thus, like this, we will calculate the fair value of NCI, right? The fair value of NCI. Okay. And when we calculate the fair value of NCI, we actually consider the full goodwill. Okay. We actually consider the full goodwill. Full goodwill means we have actually calculated the goodwill for the 80% that we are acquiring, that is acquired by the group or by the parent. I'll just state it here. That is acquired by the group. And we are also calculating the goodwill. I mean, it is inclusive, right? The goodwill for the 20% which belongs to NCI, right? Right. So we are calculating goodwill for the 80% which is for the group, and 20% which is for NCI. That means we are calculating the goodwill of the whole subsidiary company, and that is of 100% of the subsidiary company. Okay, so this was your full goodwill explanation. Now, for your NCI at fair value, as I told you, maybe say the NCI at fair value, we've calculated it to be 3000, right? So that will be mentioned here as nothing but 3000, right? Now, since we have included the goodwill in the calculation, maybe say I have measured the NCI at fair value here, okay? For this part, I have measured the NCI at fair value. Then in such a case, this NCI is at fair value. So here, whatever is the goodwill impairment, right? Fair value means I have also included the goodwill belonging to the 20% NCI which is not owned by us. So if there is an impairment, it shall also be allocated to NCI, because we've calculated the goodwill for NCI, which is inclusive here, okay, because our NCI was measured at fair value. Then in such a case, if there is an impairment to it, it shall be allocated to NCI as well, right? So if there is an impairment of the subsidiary, then in such a case, it shall be allocated to working note 4, which is nothing but 1000 is the complete impairment into 20% is the NCI value. So that will be 20 divided by 100, which is nothing but 200, right? This is the working note 4. That is your NCI at fair value. From this, you will reduce the goodwill impairment that has been calculated, right? There will be other things also here. That is nothing but post acquisition profit share, right? So if you remember, in working note 2, guys, I've already explained you. See here, working note 2, we got our post acquisition profits to be 2000, right? Our profits here were nothing but, I'll just do the sum. Our net assets here were 20,000 plus 3,000 plus 13,000, that is 36,000. But since the retained earnings increased, our profits now have become 38,000. That means that there is a 2,000 post acquisition profit. Now this, as I told you, 85% of it will belong to the group in the working note 5 and 15% to NCI in working note 4, right? So 2000, which is nothing but the post acquisition profit. So 2000, out of this, NCI is having 15% shareholding. So 15%, that is 15 divided by 100, 3000 will be added to NCI. Okay, I hope this part is clear, guys. Now we'll head to the last working note of our consolidated statement of financial position. That is nothing but retained earnings, the group retained earnings. So for our group retained earnings, guys, what we are supposed to do here, firstly, we have to take the parent company's 100% retained earnings. So whatever are the retained earnings of the parent company stated at the year end, maybe say it is 35,000. So that will be stated. Then to this we will add the post acquisition profit share, right? Post acquisition profit share. So what was the profit here, guys? As I told you, 2000 is the post acquisition profit. After that, I've acquired the company. This is the profit that has been generated. So 85% will belong to the group retained earnings. I've written your group, right? Because we are owning 85% of the company. Out of this 2000, 85% belongs to the group. So the group means nothing but the total of the parent's retained earnings plus the post acquisition profit of the subsidiary. So the post acquisition profit of the subsidiary is 2000, and this will be multiplied by nothing but 85%, which is owned by the group. So 85 divided by 100, right? That is going to be the post acquisition profit, right? So they are just showing you, I've already explained you this part, that is the fair value method, and also proportionate basis is left. I'll explain you that, but before that, I'm just showing you this working note 5, that is nothing but P is retained earnings, P is percentage of post acquisition retained earnings, and as I told you, if there is any impairment of goodwill, then in such a case it is allocated to the working note 5, that is to the group, right? So what was the impairment here? You can see the impairment is 1000, right? Out of which, since our NCI is measured at fair value, that means we are also including the goodwill of NCI, right? So we have to allocate the impairment value to NCI as well. That we allocated to our working note for here. You can see minus $200, correct? Now, $1,000, $200 is already allocated here, but the remaining $800 shall be allocated to the group, right? Because I am owning 85% or maybe say 80% of the subsidiary, correct? Here I am owning 80% of the subsidiary. So that means since I am owning 80% of the subsidiary, that means if the subsidiary's goodwill has been impaired, 80% loss I have to bear for that goodwill, right? So 1000 was the total goodwill impairment that was there. Just a second. Yeah. 1000 is the total goodwill impairment that was there multiplied by 80% that I am owning. Right? So the goodwill impairment that is to be charged to the group retained earnings is nothing but 800, and thus we get the group retained earnings, which is to be stated in the equity section of the statement of financial position, which is going to be 35,000 plus 1700 minus 800, which is going to be 35,900. Okay, so we have understood all the working notes, be it in the working note 1, working note 2. So working note 2 at acquisition we calculate 36,000, right? That is already, that should be deducted here. Okay, I think I made a mistake here. I just took retained earnings as 13,000, but maybe say it is 36,000, correct? So maybe I'll just change the values here. Okay, okay, as of now just ignore, maybe say I have taken a different amount here. Okay, the net assets of subsidiary at acquisition are only 13,000, not 36,000. Okay, so just ignore that now because I did not do the total. That is the reason why I did not consider it. Okay, so you have to do the total of all this, and 36,000 shall be reduced. Okay, if I'll change these amounts, all of the amounts shall be changed, will be changed. So I'm not doing that right now. Okay. So always just keep in mind one thing, guys. Whatever is the net assets of subsidiary at acquisition, that is 13,000 here. Maybe say it includes all of these things. Share capital plus share premium plus the any sort of retained earnings plus any revaluation surplus at the date of acquisition, right? So plus any revaluation surplus at the date of acquisition. Right? I hope this is clear, guys. You have to take everything. I had just taken by mistake 13,000. Okay, you have to take the total, that is 36,000. But assume that this is not related to the previous working note. So I just took 13,000 as the total of all of this. Okay. I hope it is clear, guys. All the working notes. Only one thing is pending now. That is NCI. So there are two methods I told you to calculate NCI. Right? The second method of calculating NCI is nothing but the proportionate net assets method. What you're going to do here is that maybe say that the net assets of subsidiary company at acquisition are maybe say 13,000 as taken earlier. That NCI will be calculated nothing as, maybe say I was owning 80% of the company, that means NCI is 20%. So NCI at the proportionate net assets method will be calculated as nothing but 13,000, which is the total net assets of the subsidiary, into 20%, which is the part of the company that is not owned, that is nothing but NCI. So 2,600 will be the NCI as per the proportionate net assets method. You're taking a proportion of the net assets of subsidiary at acquisition, right? So this is your NCI. So here we only include partial goodwill. That means you can see here, guys, we are just taking the book values of the net assets that are available, and according to that we are calculating the goodwill that we are supposed to calculate, and also the NCI. We are calculating on the basis of the book value or the fair value that we have determined, right? So here there is only partial goodwill. Here we are not calculating the goodwill for the NCI, right? So that means this amount, this 2,600, it does not include the goodwill of the non-controlling interest of 20%. right? So since it does not include the goodwill of the non-controlling interest, it will not be impaired, right? What do I mean by that? That it is not impaired. That means if you remember in working note 4, in working note 4, I charged this impairment of 200 guys for this goodwill. I've charged an impairment of 200, but since I am using the proportionate method, in such a case, even though there is an impairment of 1000, so here there was an impairment of 1000. If it was used, if the proportionate net assets method was used, so I'll just make a separate working note here. If the working note 4 I'm preparing again, okay? The working note 4 is being prepared again for the NCI, and that is proportionate method. Then in such a case, I will take the NCI at proportionate method, right? NCI's proportionate method, I've calculated it to be 2600. I will not charge any impairment here, okay? Because there is no goodwill included in this, correct guys? There is no goodwill included in this proportionate net assets method of calculating NCI, and thus impairment on it will not be charged to NCI. The total impairment shall be deducted from the working note 5, that is nothing but group retained earnings, okay? So impairment will be 0 here, and whatever are the post acquisition profit share, that will be stated here same as before, okay? Only in the working note 5 you can see here the impairment that we charge, that is 800, right? That is 1000 into 80%. But if it is proportionate net assets method here for NCI, then in such a case, instead of charging 80% of impairment here, we will charge 100% of impairment directly to the retained earnings. So here instead of 800, 1000 will be deducted. Okay. So this is an understanding for the 5 working notes that we've dealt with. That is nothing but the 2 methods of calculating NCI, right? And the last working note 5, that is group retained earnings. Okay. We will do with the latter part, method of preparing consolidated financial statements, this part. From here we are going to continue after taking a 10-minute breather break. Okay. So we are going to just stop for a while for 10 minutes. After that we return in 10 minutes. Okay. I hope, guys, everyone is back from a breather break. We'll just continue with the latter part which is pending. That is nothing but the first concept that is there here is nothing but method of preparing consolidated statement of financial position. In which case, what they are saying is that if the goodwill is positive, treat it as a non-current asset on the statement of financial position. But if the goodwill is negative, it is regarded as a gain on bargain purchase and is included as a gain within the retained earnings in working note 5. Right? So what do they mean by this? What is positive goodwill and what is negative goodwill? Is that, say for example, that P company has purchased S company by making a purchase consideration of maybe say $25,000. Okay, that means P company has paid $25,000 to purchase this subsidiary company, which is S company. Right now, maybe say the fair value of the net assets, FVNA, I'm just mentioning it as, maybe say they were 30,000. That means usually till now you've seen that whatever are the net assets that has been acquired, that is usually lower than the amount which we pay, correct? So maybe here the fair value of the net assets that we've acquired is 30,000. That means that technically while calculating goodwill, the purchase consideration that I've made, that means whatever payment that I've made for this purchase of subsidiary company, I've made 25,000, right? But for that payment, actually, how much have I received? I have received the fair value of net assets. That means I've received assets worth $30,000, right? I've received assets worth $30,000. That means I have paid less for the amount of goods to be acquired or for the value of goods that I've acquired. So that means nothing but this is a negative goodwill, right? So that is nothing but I paid 25,000 but I received goods worth 30,000, probably because the company is making a loss. They sold me at a very low value. Okay, this usually does not happen. This is probably when there is a mistake in the fair value of the net assets calculation. Otherwise, usually the purchase consideration is always higher than the fair value of net assets. Now, negative goodwill is not a name which is mentioned under ACC, or you cannot consider that as a particular referral to the goodwill, right? The name for it is nothing but gain on bargain purchase, right? Gain on bargain purchase. That means you bargained for actually getting 30,000 worth of goods and you bargained and paid only 25,000 for them, right? So this is the difference is known as gain on bargain purchase, which is negative goodwill, right? And that is 5,000, right? And since it is a gain on the purchase, guys, since it is a gain on the purchase, it will be recognized in my statement of profit or loss as a gain, right? As a gain on purchase of the subsidiary company. And if I am preparing my statement of financial position, it will then be recognized within the retained earnings, that is group retained earnings that we've understood in working note 5, right? So in working note 5, we've understood group retained earnings. This gain will be added to those retained earnings because this gain is associated with the purchase of a subsidiary company. So that is positive and negative goodwill. So when positive goodwill that is there, that is when maybe say the net fair value of net assets that have acquired are nothing but 20,000. Okay. And for that, I have made a purchase consideration of 30,000, right? So that means I've paid 30,000 for acquiring assets worth 20,000, right? So this will be a positive goodwill, right? Because the answer is also positive, right? A positive goodwill, which will be nothing but 30,000 minus 20,000, that is 10,000. That means I've paid an amount which is over and above the value of the net assets that I've acquired of the subsidiary company. So this is for probably whatever are the synergies or any sort of benefits that we get on purchasing a particular company. So this is recognized as a non-current asset under the heading non-current asset in the statement of financial position at a value $10,000 and a name given to it, that is nothing but goodwill, right? That is 10,000. So I hope positive and negative goodwill is clear to everyone. Now heading on to the next topic, that is nothing but impairment of a positive goodwill. So we have already understood how we are supposed to allocate the impairment, right? Now they are just explaining the same thing. I've already clarified that when the impairment is there, depending on NCI measured at fair value and NCI measured at the proportionate net assets method. So if it is NCI is measured at fair value, then the goodwill impairment will be allocated to the working note 5 group reserves and also to NCI according to their profit share, okay, or according to their percentage share, right? And if the NCI is measured at the proportionate net assets method, then in such a case, the total goodwill impairment will just be deducted from the group retained earnings working note 5. Always keep this in mind. Okay. So if the goodwill is considered to have been impaired during the post acquisition period, this must be reflected within the group financial statements, right? As I told you, it must be reflected, this impairment. Accounting for the impairment differs according to the policy followed to value non-controlling interest, reflecting the ownership of the goodwill. So as I told you, it depends on the non-controlling interest measurement, that whether you've measured the non-controlling interest at fair value or proportionate method, right? So if it is proportion of net assets method, then whatever is the goodwill impairment, it will be nothing but group reserves account debit to goodwill, right? So for example, my goodwill has been impaired by $1,000, right? This is my goodwill impairment. Now, the NCI is measured at the first one, proportion method, right? NCI is measured as per the proportionate method. So the journal entry will be nothing but whatever is the total impairment of goodwill, $1,000, that will completely be deducted from the group retained earnings, that is in my working note 5. So when I prepare my working note 5, I will deduct it from there. For this, I've already shown you the working. And 2, I will reduce goodwill on the face of statement of financial position. The goodwill will be reduced, right? Goodwill is a non-current asset. If it is credited, that means I'm reducing its amount by that value, that is $1,000 here. Okay. So when I state my consolidated statement of financial position, in that my goodwill, whatever amount is there, minus this complete impairment of 1,000, right? If say the goodwill for the year, goodwill till date was actually 12,000. From this, I will remove the complete impairment of goodwill of 1,000 and the remaining will be 11,000 that we get, which will be recognized in my consolidated statement of financial position. Okay. I hope the positive, negative goodwill and the impairment is clear to you. Only the last part of impairment is nothing but the fair value method. So if in case the fair value method is used, guys, then in such a case, I told you, in case of fair value method of measurement of NCI, the non-controlling interest, we are also including the goodwill of the 20% or maybe say 30% of the non-controlling interest that we do not own, right? Maybe it is a partly owned subsidiary, maybe I've acquired 70% of the company and the remaining 30% is my non-controlling interest, right? So for that non-controlling interest also I've included the goodwill if I'm measuring the NCI at fair value method. Okay. So if the goodwill of NCI is there, the goodwill impairments shall also be allocated to the NCI. Correct. So fair value method states that the journal entry will be nothing but remove the goodwill amount from the group reserves or group retained earnings. That is working note 5. That means you're debiting it. That means you're deducting it from the working note 5. Debit NCI, again deducting it from the working note 4. Okay. The whatever is the profit share, whatever is the percentage share. Okay. And goodwill will be credited by the same amount. So if for example that my NCI was 20%. Okay. NCI was 20% and it was measured using the fair value method. Okay. And the complete goodwill impairment is nothing but $1,000 taking the same value. Okay. For the sake of simplicity here. So what will be the journal entry here is that you're going to deduct your group retained earnings. So group retained earnings account debit. Okay. But that is working note 5 will be debit. Right. You will also deduct it from the NCI, right? That is working note 4. That is also debit, correct? And lastly, you will deduct it from the face of the statement of financial position in from the goodwill, that 1000, right? So now 1000 is reduced in goodwill, so I just take directly firstly that 1000, right? My goodwill value has gone down by 1000 on the face of statement of financial position. Now this will be allocated between the group retained earnings and the NCI. Now NCI is the part of the company that we do not own, right? That means 20% of the company we do not own, of the subsidiary company, right? So that means 20% will belong to this. So 1000 is the total impairment into 20% which we do not own, right? To NCI, the goodwill impairment will be allocated as 200. That means that 200 will be reduced from working note 4. Okay, and remaining will be reduced from the working note 5, that is 1000 minus 200, which is going to be 800, or you can also say that it is calculated as nothing but 1000 into 80% of the company that we are owning, that is nothing but 800. It is going to be the same amount, however you calculate. Okay, so this was the calculation of the impairment of goodwill that I already explained you, but just clarifying it again if in case you all have any doubts regarding it. Now, the pre and post acquisition profits. This concept also I have stated that if the subsidiary has a pre acquisition profit, we are not entitled to that profit because it is a profit or it is the retained earnings which is owned or which is earned by the subsidiary before we acquired that company, right? So that means it is the hard earned money of the subsidiary company. So obviously we are not entitled to that subsidiary company because we did not have control over it or we did not acquire that company, right? So maybe I acquired the subsidiary company on 1st Jan, okay, and on that date maybe the subsidiary's retained earnings are 20,000, okay, subsidiary company's retained earnings are 20,000, okay. Now this is the retained earnings of the subsidiary that they have allocated till date, and till this date I had not acquired the subsidiary company. I acquired the subsidiary company on 1st Jan. Okay. So before 1st Jan, this is the pre-acquisition profit, correct? So this is the pre-acquisition profit. So this is earned by the subsidiary. I do not have an entitlement to this, right? I do not have an entitlement to this. But maybe say by 31st December, by the year end, maybe say the profits, the retained earnings of the subsidiary company has increased to 32,000, right? That means there is a post acquisition. That means after acquiring the subsidiary company, I acquired the subsidiary company on 1st Jan. By the year end, the subsidiary company's retained earnings has increased from 20,000 to 32,000. That means the post acquisition profits are nothing but 32,000 minus the 20,000, those were already existing at the date of acquisition. That is 12,000. So these post acquisition profits, we are entitled to these profits only. Okay, because these are the profits earned by the subsidiary company after that we've acquired this company. Okay, so that is what they are talking about, pre-acquisition and post-acquisition profits. Okay, pre-acquisition profits are reserves which exist in a subsidiary at the date when it was acquired. They are capitalized at the date of acquisition by including them in the goodwill calculation, right? So what they are saying is that this is a pre-acquisition profit. This is available at the date of acquisition, right? So this is my net assets of the subsidiary at date of acquisition. Net assets of the subsidiary company at the date of acquisition was 20,000, right? And if you remember in working note 2, we have seen that the net assets of subsidiary at the date of acquisition are to be reduced, right? I'll just write here. Yeah. So net assets of subsidiary, right? So the net assets of subsidiary company at the date of acquisition, 36,000 should have been deducted, but this I've done it separately, so don't get confused here. Here it should have been 36,000. Okay, but just assume that this is a different example. So that is to be deducted because we are paying goodwill. So we are actually technically purchasing the share capital, we are purchasing the pre-acquisition retained earnings, we are also purchasing the share premium available at the date of acquisition. That is what this point is trying to note. Okay. The second point, post-acquisition profits are profits made and included in the retained earnings of the subsidiary following its acquisition. They are apportioned between the group retained earnings and the NCI, right? So as I told you, this is the post-acquisition profit that I calculated, right? It was 32,000 by the year end. At the start of the year, it was 20,000 when I acquired the subsidiary company. So 12,000 is the profit that we have earned after I've acquired the subsidiary company. So this will be distributed between me and the NCI. Maybe I have acquired only 90% of the subsidiary company, right? So out of this, 90% will be allocated to the group, that is nothing but the parent company, and 90% of the subsidiary company, right? 90% will be allocated to the group. It will be added to your working note 5, right? Because it is a profit, right? It will be added. And the remaining, that is 12,000 into 10%. This belongs to the NCI because 10% of the company is not owned by us, right? So this will be added to your working note 4 because this is a profit, right? And these adjustments we've already seen in the working notes while preparing them one by one, right? Now, let us understand one practice sum on calculation of your non-controlling interest. Jack Company has acquired 60% of the ordinary share capital of Daniel, and that is on 31st December 2006 for a value $240,000. At this date, the net assets of Daniel were $360,000. What goodwill arises on the acquisition if the non-controlling interest is measured at value using the proportion of net assets method, and the second one if the NCI is valued using the fair value method, and the fair value of NCI on the date of acquisition is $150,000. Usually they mention if they are requiring you to use the fair value method of NCI, they will mention the value directly, or they might state that 20% is the NCI. That means maybe say 80% of the company is acquired. So obviously 20% is the NCI, and they will state the share price of the subsidiary company. So you can multiply it with that and calculate the fair value of the NCI, right? So in this sum, guys, they are requiring us to calculate both for proportion of net assets method NCI and also for the fair value, right? The goodwill we are supposed to calculate for both of them, right? Now Jack acquired 60% of the ordinary share capital of Daniel on 31st December 2006 for $240,000, right? So that means fair value method, right? I'm doing it for both fair value method and also proportion method, right guys? Fair value method and proportion method. Now firstly, for goodwill, what we will see, the consideration transferred, the amount that I've paid, that is considered, correct? So the consideration paid or the consideration transferred, it will be the same obviously for both 2,40,000 because I've paid 2,40,000 for purchasing this company, right? 2,40,000, right? I have acquired how much? 60% of the company. So obviously it is my subsidiary. Okay. At this date, that means at the date of acquisition, the net assets of Daniel were 3,60,000, right? The net assets are going to be deducted because we have received, right? We have to calculate goodwill. So the amount which we paid less the amount of the value of the net assets that we've acquired, right? So firstly, we have to calculate non-controlling interest. So for non-controlling interest at fair value, they've directly mentioned as the value that is going to be 1,50,000. So I'm just directly stating that, right? And if there is a non-controlling interest for proportion method, it will be nothing but the net assets. See, at the date of acquisition, whatever are the net assets. Here the net assets at the date of acquisition are 3,60,000. 3,60,000 multiplied by the NCI percentage. I own 60% of the company. That means NCI is the remaining 40%, correct? That means that 40% of the company is not owned by me. So 40% of it will be nothing but 1,44,000. Always remember, NCI at fair value is usually going to be greater than the NCI at the proportion method. Okay. And lastly, from this we deduct the net assets of subsidiary company at acquisition. Always remember, only the net assets at acquisition are to be reduced, not the post acquisition net assets. Okay. So here, what is the net assets at acquisition? It is nothing but 3,60,000 directly stated here. So 3,60,000 we've received for purchasing, for paying this much amount. So this will be deducted for identifying the amount which we have paid over and above the value of 3,60,000. Right. So our goodwill under both methods will be nothing but, I'll just do the total of this and also this. So it will be 30,000 here and 24,000 here. This is how you're supposed to calculate NCI under both methods. I hope everyone is fairly clear with this part. So now the fair value adjustment. Let us understand the fair value of consideration and net assets. To ensure that an accurate figure is calculated for goodwill, the consideration paid for a subsidiary must be accounted for at fair value. As I told you, the net assets that we acquire when we purchase the subsidiary company, it shall always be fair value, right? So that we can identify the up-to-date value of the assets that we are purchasing from the subsidiary company, right? And secondly, the subsidiary's identifiable assets and liabilities acquired must be accounted for at their fair values, right? Now, before doing the calculation of the cost of investment, what I'm saying is that, as I told you, maybe when we are consolidating, we are calculating the fair value of the net assets of subsidiary company at the date of acquisition, correct? So whatever are the fair values of the assets of subsidiary company at the date of acquisition, that we are supposed to consider and deduct from here, net assets of subsidiary company at acquisition, right? So this we are supposed to consider. Now, since we are calculating fair value, right, at the date of acquisition, maybe the book value for a particular asset, maybe say a building. No, not a building. Maybe say the net asset that we've acquired is nothing but maybe say retained earnings or anything. Maybe just I'll take normally net assets. Okay. If the book value of the net assets, okay, I'm just writing here book value, BV. Okay. If the book value is, for example, 20,000, okay, and I have fair valued it. Okay. I did the fair value because I'm purchasing the subsidiary company, right? So the fair value of net assets of subsidiary company maybe are actually higher than this. Maybe it is 30,000, right? Maybe it is 30,000. It could be any building being revalued, being going upwards, or any sort of assets of the subsidiary company going upwards, because of which the fair value is greater, right? So then in such a case, in my working note 2, what I'll do is, yeah, so this I have prepared working note 2. I'll just copy paste this thing. Right? So this is my working note 2, the net assets of subsidiary at acquisition and whatnot. Just a second, guys. I'll just insert one row. Yeah. So now this is the calculation net assets of subsidiary at acquisition at the reporting date and the post acquisition differences, right? But say for example that I purchased that I fair valued the building on the date of acquisition and there is a fair value adjustment, right? There is a fair value adjustment. Maybe the building that I fair valued, its value got increased, correct? Its value got increased. So then in such a case, I will have to do a fair value adjustment, right? So on the date of acquisition, maybe the building's value was 20,000, but it got increased to 30,000. That means on the same date, the net assets of subsidiary has increased, correct? Because on acquisition, I fair valued it. The net assets of the subsidiary has increased, correct? Because the net assets of subsidiary had a value in which the building was there of 20,000, but now it became 30,000. So it has increased by 10,000, right? So at that acquisition and at the reporting date, it will be 10,000, right? Now maybe say this subsidiary, I had acquired it 2 years ago. Okay. I acquired this subsidiary company 2 years ago, guys. And on that date, maybe say the useful life of this building was 10 years. Okay, the useful life of the building was 10 years. So, on that date, that means at the date of acquisition. Okay, always keep it in mind. So, maybe on that date, the useful life of the subsidiary's building is nothing but 10 years. So, at the acquisition date, its value will be increased by 10,000. But after that, I will charge depreciation, right? In order to calculate its today's value, right? So, fair value depreciation will also be charged. That will only be affecting the reporting date for calculating the values at the uh, year end, at the reporting date, right? So, this was maybe at 1st Jan or maybe at 31st December. Maybe this was in 2003, I'll directly state. Okay. And here it is in 2005. So at the reporting date, I will have to calculate the carrying value of an asset which was fair valued at 2003 for a 10,000 increase in value. Correct. So it will be depreciated now. So what will be the depreciation? The depreciation, guys, will simply be on the excess value, that is nothing but 10,000. 10,000 is the excess fair value, and I'm just charging depreciation on the fair value. That is why I've mentioned fair value depreciation. So that will be nothing but 10,000 into, since 2 years have passed, I'll charge 2 years of depreciation. So 2 divided by 10 years of useful life. So divide by 10. So the fair value depreciation will be nothing but 2,000, right? So by charging depreciation of 2 years, I will identify the fair value carrying value at the reporting date of this, right? And thus my net assets will thus be adjusted, which is going to be nothing but 46,000 here. Here it is going to be nothing but, okay, why is it 46,000? Has it tallied or something? I'll just redo this thing, just a second. Yes, it is 46,000 only. So then there will be no post acquisition profits. Okay. Maybe I'll just do one thing. Maybe to make a change, I'll just state it as 17,000. So then this will be 48,000 and my post acquisition profits will be 4,000 here. Okay. Did you all understand this, guys? And this will be subtracted minus 2,000 because in the post acquisition, I've already charged a depreciation of 2,000, and thus the post acquisition profit that I will get is nothing but 4,000, which is the increase in retained earnings, minus 2,000, which is the depreciation charged after the acquisition of the subsidiary company, right? So 46,000 is at acquisition. At reporting date, the value has increased of the profits, and thus the profits value increase is stated as post acquisition. Then this last column value, this 2,000, will be distributed between the group and NCI as per their percentage share. Okay. So that is your fair value adjustment. Then calculation of cost of investment. Now, while purchasing the company, there could be many components that would be involved. For example, till now we saw that we are just paying a particular amount, maybe in the form of cash. We are paying the subsidiary for actually purchasing the subsidiary company, right? But in case of calculation of the goodwill, the payment that we are making initially, right? The purchase consideration that we are given, that is not just in the form of cash that we are paying. That is probably also in the form of share exchange. That maybe if I want to pay you, I'll pay you in the form of share exchange. Okay. For every 2 shares that I acquire from you, I will give you 1 share from my side. Okay. So that means you will get 1 share for every 2 shares that I have purchased from you, and that will be a payment made in the form of share exchange. Or it could be a payment made which is in the form of deferred consideration. That means maybe I'm acquiring your company today. Today is what? 1st Jan 2008, for example. Okay. So after 2 years, I will make you the payment. Okay. Maybe say 10 million I'm supposed to pay in total. 5 million I'll pay you right now. 5 million I'll pay you after 2 years. So that is known as deferred consideration, and that should be a part of the purchase consideration that we are making in the working note 3, the first thing that we are calculating for the complete calculation of goodwill, right? So that is what the concept of cost of investment tells us. Now the cost of acquisition includes the following elements. First is the cash paid at the date of acquisition. the fair value of any other consideration paid, like any deferred consideration or contingent consideration or any sort of share exchanges, right? Also, contingent consideration could be there. What is contingent consideration? Contingency means something which may or may not happen in the future. Okay. For example, I purchase subsidiary company. Okay. But I'm telling them that 5 million I'll pay you today. 5 million I'll pay you in the next year, provided my profits increase by 10% by the next year. So if my profits increase by 10% by the next year, then and only then I will give you the excess 5 million amount. Otherwise, I won't give you. So that depends on the profit that is going to be there in the future date, right? Which may or may not happen within in the future date, because it is not under our control, right? It is just a foreseeable future which cannot be seen technically, right? So in such a case, there is a contingent consideration and it shall be measured at fair value. Even in case of deferred consideration, it shall be measured at fair value, but fair value here is different. It is like the present value that we are supposed to calculate. Okay, incidental costs of acquisition such as legal, accounting, valuation, and other professional fees should be written off as expense. So any costs which are associated with the purchase of a subsidiary company, it being the legal costs for actually purchasing it, or any accounting valuation because you have to fair value the assets of the subsidiary, or any professional fees that you're paying to ensure that the subsidiary purchase will be good enough for the company or not, right? So those expenses are not directly attributable or directly related to the subsidiary company, and thus they are to be directly expensed to the statement of profit or loss, not capitalized to the cost of investment. Okay. The issue cost of debt or equity associated with the acquisition should be recognized in accordance with IFRS 9 or IAS 32. That is nothing but a part of your financial instruments. Okay. So now let us look at the sum wherein they have included certain things, it being the deferred consideration and also the share for share exchange. Okay. Before looking at this sum, guys, we'll just take a 10-minute break again, after which we'll continue with the latter part. So we'll return after 10 minutes, that is by 12:03. Thank you. Okay, guys, are we back? Okay, so now let us solve a sum on this cost of investment that we are supposed to calculate. Now, Jack has acquired 24 million $1 ordinary shares of 80%. That means the total number of shares might be around 30 million, and Jack has acquired 80% shares, that is 24 million, of the ordinary shares of Becky by offering a share for share exchange of 2 shares for every 3 shares acquired in Becky, and a cash payment of $1 per share payable 3 years later. Jack's shares have a nominal value of $1 and a current market value of $2. The cost of capital is 10% and the value of $1 receivable in 3 years' time can be taken as $0.75. You are required to calculate the cost of investment and show the journals to record it in Jack's financial statements. Show how the discount would be unwound. Okay. So guys, here as you can see, there are quite a lot of components here. First is that Jack has actually acquired 24 million shares. Okay. Acquired 24 million shares in which company? Becky company, right? So Jack company has acquired 24 million shares in Becky company, and that represents 80% of the shares acquired in Becky company, right? So it is a parent subsidiary relationship here. Now, for actually acquiring 24 million shares, how did they make a payment? So firstly, they offered a share for share exchange. That means they are paying in the form of share exchange, right? So your cost of investment will include all these things. Okay. That is firstly share exchange payment, right? So what is the share exchange payment? It is nothing but um, it is offering a share for share exchange of every 2 shares for every 3 shares acquired in Becky. That means Jack is giving up 2 shares for every 3 shares that it is acquiring in Becky company, right? So they are paying 2 shares. So firstly, they are acquiring 24 million or 24,000 shares. I'll just write it here, right? And out of this 24,000 shares that they are acquiring, they are giving up 2 shares, and divide by they are receiving 3 shares for it. Okay, so that means technically they are paying in the form of shares. That is 2 divided by 3. Now, since the parent company is paying, what is the value they are paying in the form of shares? For that, you have to identify the market value of the shares of parent company, because then they are paying it in the form of market value, correct? So if, for example, the parent company's market value of each share is $3 and they are giving up 2 shares, that means they are paying $6, right? $3 into 2 shares given up, that is $6, correct? So here in total, they are giving up 24,000 into 2 by 3 shares, and it will be multiplied by the share value of the parent company. That is nothing but what it is mentioned here. You can see that $1 is the nominal value, and you have to take the market value, right? Because the market value of the shares is considered, right? The current market value is $2, because the shares that they have given it to the others for actually in the share exchange, they've given per value of share as $2, right? So the share exchange will be nothing but 24,000 into 2 divided by 3 into $2 per share. That is going to be nothing but 32,000. Then after that, so we have understood the share for share exchange. Now after that, there is also deferred consideration, you can see here. Okay, that and a cash payment of $1 per share is payable 3 years later. That means how many shares are they acquiring? Deferred consideration, right? How many shares are they acquiring? 24 million shares, right? And they are paying $1 per share, but they are paying this after 3 years, right? They are paying this after 3 years, correct? They are paying $1 per share. You can see here it is $1 per share payable after 3 years. And for that, you have the cost of capital given to you as 10%. So whenever, now this payment that you're going to make, you're going to make it after 3 years, correct? 3 years later, right? Now, whenever you have a deferred consideration, that means right now you purchase the company, that but for that you're going to make a payment after 3 years. That means deferred consideration, okay, is nothing but your liability. Okay, I'll just increase the size here. So deferred consideration is nothing but your liability, right? Because you have to pay after 3 years the amount. But whatever is the amount, now you have to pay 24,000 because you're paying $1 for each share acquired in that company, right? You have to pay 24,000 after 3 years. But you are presently obliged for paying those 24,000 because you've purchased the company. So something which is to be paid after 3 years, you have to calculate the present value of that. Okay? You have to calculate the present value of that. And for the calculation of present value, they will always give you an interest rate like it is given here, the cost of capital of 10%. Right? So applying the cost of capital and the present value formula, you will form the formula that will be applied is nothing but 1 divided by 1 plus R raised to n. Okay, and I'll just substitute the values. Okay, so this will be multiplied by the future value, correct? So by applying this formula, whatever is the future value that I'm supposed to pay, I'll get the present value of that future value, right? So 1 divided by 1 plus R is what? 10%. So 10% means nothing but 0.10 if I want to write it as raised to n. Now what is n? N is the number of years by which you want to present value it, right? So in this case, it is going to be paid after 3 years. So if you want to calculate its today's value, you will take it 3 years back. That means you will present value it by 3 years. So n will here be 3 years. Okay. So you'll just have to calculate this amount into 1 divided by 0.10 raised to 3. But they don't want you to actually follow such a big method of presenting the whole formula and everything. So for that, they've directly given you a value, that a present value at a value of $1 in 3 years time, it can be taken as $0.75. When you calculate this amount, you will get around $0.75 only, right? And they've directly given you this amount, right? So this amount will directly be multiplied with the future value, that is 24,000, correct? Yes. So here 24,000 into $1 into 0.75, that is the value directly given for this calculation. Okay. So that will be nothing but, let us calculate 24,000 into $1 into 0.75, right? That will be 18,000. This is the present value of the deferred consideration, which will be capitalized as the cost of an investment, right? So we have calculated both of them, right? Now we'll just identify the total cost of investment. So the total cost of investment is nothing but 32,000 paid plus 18,000 paid, that is going to be 50,000. Okay, there is nothing else pending in this question. The only thing that is pending is you have to calculate the cost of investment and show the journals to record. So we've calculated the cost of investment, correct? Now we have to pass the journal entry, right? So how will we pass the journal entry? Cost of investment, right? It is to be capitalized as an investment. This cost of investment is stated as a non-current asset in the individual financial statements, correct? Of the parent company, right? Because it is a cost of investment which is going to bring them future economic benefits. So cost of investment will be account debit, right? And that is nothing but we calculated it to be 50,000, right? Because it is an asset, by debiting it, I am recognizing it. 2, my deferred consideration, right? It is my deferred consideration. I have to pay the amount. That means in the future date, it is my liability because in the future date I have to pay the amount, correct? So liability credited, that means liability recognized, and that will be nothing but 18,000 that we calculate, right? And 2 will be share capital and your share premium, right? Because for your share capital, whenever you issue shares, they are always issued at their nominal value. Okay, and the market value that is there, that is the premium amount that you get. Okay, so what is the nominal value here? The nominal value, as you can see, Jack's shares had a nominal value of $1. That means how much of the share capital has been issued? It is nothing but equal to the same thing. 24,000 shares have acquired, right? Into $1 into $2 per, sorry, into 2 divided by 3, right? divided by 3. It is, I'm talking about this share exchange, right? 24,000 into 2 divided by 3. Nominal value is $1, so I'll multiply it with $1, right? So 16,000 will be my share capital, and for my share premium, the other $1 will go because my market value is $2, but my nominal value is $1, right? So $1 will go to share capital, $1 will go to market to the share premium, right? So same thing again, 24,000 shares I've acquired into 2 divided by 3 by the way of share exchange payment into $1, that is for your share premium. So it will give you 16,000, right? So here it will be nothing but 18 plus 16 plus 16. That is the total cost of investment. This is how you will pass the journal entry, and you've recorded the journal entry, you've calculated the cost of investment. Now there is something which is known as discount unwinding. What is discount unwinding, guys? What we did is we had to pay 24,000, right, for that deferred consideration. For that deferred consideration, we had to pay 24,000, right? But we had to pay it 3 years later is the reason why it is stated as a deferred consideration, which is a liability, right? And we have included the present value, which is lower than 24,000, that is 18,000. But eventually, after 3 years, we have to totally pay 24,000, right? We have just capitalized the present value of the deferred consideration 18,000. But after 3 years, we have to pay the total of 24,000 because that is our liability. That is the commitment that we have made, right? So if 24,000 is paid over the period of 3 years, right now its value is 18,000, right? Over the period of 3 years, it has to reach 24,000. How will it reach 24,000? For present value, we use the interest rate of 10%, correct? For present value. Now to calculate the future value, we will use the same interest rate, right? So initially, what is the journal entry? It is cost of investment, account debit. I'm just copy pasting the previous journal entry to deferred consideration, right? Only for the deferred consideration part, right? It is stated, it is capitalized as a cost of investment, but only the present value, that is 18,000, 18,000. Okay. And this is at the start of the first year, right? At the start of the first year. By the first year end, I will have to charge certain interest on this, so that from 18,000, the deferred consideration ranges up to 24,000, right? So what is the journal entry that I'll pass? Finance cost account debit to deferred consideration. Okay. And that amount will be nothing but 18,000. Since we have used 10% to calculate the present value, again we'll use 10% to calculate the future value. So 10 divided by 100, right? That will be 1800 and 1800. So I have increased my deferred consideration by the first year end to by 1800, right? So that means for the second year opening, the total deferred consideration opening is there. That is nothing but at the start of the year, it was 18,000 plus I've added 1800 by the first year end, right? So my deferred consideration opening balance is 19,800. Now again, I'll pass the same journal entry. Finance cost account debit. Always remember, finance cost account debit will go to your P&L, right? Deferred consideration. That means only the present value is going to be capitalized to the cost of investment. After that, whatever is the later this 1800 and all those changes, that will not be capitalized to the cost of investment. Now, what I'll do is I'll calculate 10%, but not on 18,000. Now my balance is 19,800. So I will calculate it on that. So 19,800 into 10 divided by 100. Right? That is 1980, 1980. Then again, for the third year opening, deferred consideration, my complete value of deferred consideration, it was 19,800 at the second year end, sorry, at the second year opening, plus 1980 charged. So at the second year end, its value is nothing but 21,780. And the last one I'll charge for the last year, finance cost account debit to deferred consideration, right? And it will be again on the balance of deferred, that is third year opening balance 21,780 into 10%. right? So it is nothing but 2178, right? Now, what is my deferred consideration total at the third year end? This is for the third year, correct? Third year adjustment that I've made. In the third year, it will go to my finance cost. So what is the total of the deferred consideration at the third year end? The balance was 21,780 plus I charged 2178. So that will be 23,958. It is almost equivalent to 24,000. It is just because of certain approximate values that we have taken, because we took here 0.75, right? For the calculation, we took here 0.75. Isn't it? 0.75 is the reason why there is a difference. Otherwise, it will match up to 24,000. So my deferred consideration total liability that is there is nothing but 24,000. And once I pay the cash for it, the liability will be removed. That means it will be debited, deferred consideration account debit to cash going out of the business, right? So this will be nothing but 24,000 and it is settled over the period of 3 years. Okay. I hope this concept is completely clear. I've shown all the journal entries, all the accounting that was necessary for the calculation here. Okay. Now, contingent consideration. In case of contingent consideration, guys, the only thing that I want to mention here is that you should calculate the fair value of the contingent consideration. There is no sum on it right now, but when we do the sample questions tomorrow, there will be a sum on it where you can identify the adjustments that you're supposed to make or the calculations that you're supposed to do for contingent consideration. Okay. Then share exchange. Share exchange, guys, I've already explained it to you through this sum itself. So I don't think I need to get into the details of it again, right? I think it is pretty much clear to everyone. Often the parent will issue shares in itself in return for the shares acquired in its subsidiary. So the share price at acquisition should be used to record the fair value of the shares that we are supposed to do. Now, post-acquisition revaluations. Now, if you remember, if the subsidiary company has pre-acquisition revaluation surplus, right? I think you already know of what is revaluation surplus already, so I'm not explaining it. It is when your asset is revalued upwards, you get a revaluation surplus, which is stored in the owner's equity. That is nothing but OCI, right? So there is a revaluation surplus, which is pre-acquisition revaluation surplus, right? Pre-acquisition revaluation surplus. So that revaluation surplus is not shown in the consolidated financial statements because that was subsidiary's revaluation surplus before I acquired it. So I am not entitled to this amount. So this will be adjusted in the goodwill, right? Because in the goodwill, we state minus net assets of subsidiary company at acquisition, right? It is nothing but purchase consideration plus NCI minus net assets of subsidiary at acquisition. So in the net assets of subsidiary at acquisition, this revaluation surplus will obviously be there. So it is adjusted in the goodwill, right, guys? The post-acquisition revaluation surplus is normally treated as a normal revaluation surplus, right? So say for example that my subsidiary's net assets, maybe my subsidiaries for one particular asset got fair valued, right? So maybe, you know, its book value was 1 lakh, it got fair value to 1,30,000, right? 1,30,000. This is post acquisition. After that, I've acquired the subsidiary company, there is a revaluation surplus, right? So 30,000 is the revaluation surplus. So it will not touch my working note 2. Okay. My pre-acquisition revaluation surplus will be stated in the working note 2 when we calculate the net assets of subsidiary at acquisition. But the post-acquisition revaluation surplus will not touch my working note 2. Okay. It is not going to touch my working note 2. What will happen for this is that I will just directly state asset account debit. Asset is increasing because I'm debiting it, right? It is a revaluation increase. That is nothing but 1,30,000, which is the new fair value minus the book value of 1 lakh. That is 30,000. And 2 will be stated revaluation surplus account. Okay, that will be again 30,000, right? And this will go to your consolidated OCI. Okay, and this will go to your consolidated other comprehensive, consolidated statement of financial position. Okay. Now, the only thing is that this is stating that maybe I had acquired 100% of the subsidiary. If, for example, I acquired maybe say 80% of the subsidiary, then in such a case, what will happen? Then in such a case, if the revaluation increases 30,000, 80% will belong to me and the 20% will belong to NCI. So 80% will belong to the group, right? And 20% will belong to the NCI. So then in such a case, in the group consolidated financial statements, what the value will be, that I'll show you. I'll just show it to you here directly, guys, because there's a sum here. Yes. Yes. So here P has owned 80% of S company for many years. During the current year, P and S both revalue their properties for the first time. So that means parent company has acquired subsidiary company years ago, right? And now the subsidiary's property and the parent company's property has been revalued. Both properties increase by 1 lakh, right? So what will be the journal entry that you pass? The journal entry that you will pass is going to be nothing but both the parent company's just a second. The parent company's asset is revalued. I mean, there is a revaluation surplus of 1 lakh. Subsidiary company's asset is also revalued. There is a revaluation surplus of it on it of 1 lakh. Correct. So here my asset in total has been increased by 2 lakhs. Right. That is 1 lakh of the parent company's asset. Right. When we consolidate, we add their assets. Correct. So plus 1 lakh of the subsidiary's asset. Right. But 2 will be what? 2, it will be going to nothing but revaluation surplus, right? Revaluation surplus account, and the value will be nothing but 1 lakh total of the subsidiary plus 1 lakh into 80% of the, sorry, 1 lakh total of the parent company. This first 1 lakh is of the parent company plus 1 lakh into 80% of the subsidiary company, because we do not completely own the subsidiary company. So in our consolidated OCI, 80% of it will go, right? So it is nothing but, okay, I've stated an extra amount here. Yeah, it is nothing but 1,80,000, and for the remaining part, it will go to NCI. In your working note 4, it is going to be nothing but 1 lakh was the revaluation of the subsidiary's asset into 20%. Right? That will be 20,000. So here what all is added? 1 lakh of the parent company's revaluation plus 1 lakh into 80% of it of the subsidiary, because we own 80%. So 80% will be credited to revaluation surplus and 20,000 to OCM. Right? This is for your post acquisition revaluations. Right? Now we'll understand the intra-group trading in the consolidated statement of financial position. So for the intra-group trading, guys, there are types of intra-group trading. That is, one is the parent and the subsidiary may well trade with each other, leading to the following potential problem areas, right? That is nothing but current accounts between P company and S company, right? Loans held by one company and the other, dividends and the loan interest, unrealized profits on the sale of inventory, and unrealized profits on the sale of non-current asset. I will make you understand each and every concept here because all of these are very important. Okay, so let us deal with the first one, that is nothing but parent and subsidiary may well trade with each other, leading to the following potential problems. The first one is current accounts between parent and subsidiary company. Okay, so before dealing with this, we'll just take a 5-minute break, guys. We'll just take a 5-minute break, and after that, I'm going to explain you the complete complete intra-group trading and what are the consequences of it. After that, in the next class, we'll be doing consolidated statement of profit or loss. Before completing consolidated statement of financial position, I will also make you all do the CBE platform understanding and the study hub. So don't go anywhere. We'll just be back in 5 minutes. Okay, guys, I'm hoping we are back. Now we'll understand an important concept, a very important concept of our consolidation. That is nothing but intra-group trading, wherein we have all these intra-group tradings and we are supposed to understand each one of them one by one. Right? So I intend to complete this part at least today. Now, firstly, we'll understand the current accounts between the parent and the subsidiary company. Right? So what happens is, maybe say the parent company and subsidiary company are trading, right? They are trading amongst themselves. They are maybe purchasing certain goods from one another. They are selling certain goods to one another and so on. Now, maybe they are purchasing and selling on credit basis. Okay. So, in their individual financial statements, maybe say the parent company has purchased goods of $1,000 on credit from subsidiary company, right? So what will parent company state? Parent company will state subsidiary as its payable, right? Because it is a payable for parent company, right? In the parent company's individual financial statement, subsidiary will be its payable, right? Subsidiary will be its payable because the parent company is obliged to pay subsidiary for the goods that it has purchased from the subsidiary company, right? And for the subsidiary company's individual financial statements, subsidiary will state it as a receivable because the subsidiary company has sold the goods to the parent company, right? So parent company will be subsidiaries receivable in their individual financial statements. But these are intra-group transactions. Guys, these are intra-group transactions. And under the consolidation, we assume that it is a single entity concept. So if in case it is a single entity concept, how can I have a payable and a receivable both at the same end, right? In the same company, I cannot repay myself, correct? I cannot repay myself. So this payable and this receivable that is only between the subsidiary and the parent company shall be eliminated. Okay. So these are known as nothing but current accounts which shall be eliminated in consolidation, right? That is current liability for one entity and a current asset for another. Okay, but these shall only be removed provided it is a receivable or payable related to the parent and subsidiary. Okay, if for example the parent company has a receivable of 3,500. Okay, sorry, maybe parent company has a payable of 3,500. Okay, maybe parent company has a payable of 3,500. Now out of this payable of 3,500, 1,000 would be relating to the goods that the parent company has purchased to the subsidiary company, right? From the subsidiary company, the parent company purchased goods of 1,000. So it shall be removed from the payables of the parent company, only that 1,000, because other payables might be related to some other third parties, right? So the payable should be there, only the 1,000 of which is related to the transaction with the subsidiary company, that shall be eliminated. Okay, and if the subsidiary had a receivable, right, receivable of the subsidiary company, maybe it is 2,000, right, or maybe say 1,900. Okay, is the total receivable, out of which $1,000 worth of receivable is associated because of the transaction with the parent company, correct? So then that will be eliminated only. That means only 1,000 will be subtracted from here and that will be 900. So these are the current accounts between the parent and subsidiary company which are to be eliminated. The second one, loans held by one company in the other. Okay. So that means maybe for purchasing a company or maybe for, just giving out a loan. Maybe the subsidiary company would want to actually invest in a particular project, but the subsidiary company does not have cash. So what does the parent company do? Parent company gives a loan to the subsidiary company, right? So here guys, what will happen? If the parent company has given a loan to the subsidiary company, it is an intra-group loan, right? They can give loan at any interest, at any value, no matter what the debt, whatever is the debt of the subsidiary, they can give any amount. So this can be manipulated. So this is an intra-group loan which shall be eliminated, because technically if it is a single entity concept, I am assuming that P company and S company are the same entity. So I cannot give myself the loan and pay the interest on the loan, correct? So for parent company, it is going to be an investment, right? In the statement of financial position, under the head non-current assets. For parent company, it will be an investment. Maybe say that the intra-group loan value is $40,000. Okay. So for parent company, it is an investment of $40,000, right? And in the liability section, right? This is parent company, P company, and this is S company. Okay. So for the parent company, it is 40,000 investment. In the liability section, S company will state a non-current liability of 40,000 because the S company has taken a loan from the parent company, right? So these two things, investment in one company and a non-current liability in the other, maybe a bank loan or something will be stated, or not a bank loan, maybe a loan will be stated. These two are going to be removed. Okay, just keep it in mind. These two are going to be removed because these are intra-group loans. Now what happens in intra-group loans also, it also affects your statement of profit or loss. I'm just explaining it a little bit here. So if S company has taken a loan from the parent company, right? So on that loan that S company has, S company would also be paying a interest, right? So a finance cost must be paid by the S company. So that must be stated in the P&L, correct? Finance cost account, debit to liability or whatsoever is the journal entry, correct? For it. So finance cost will be stated in the P&L of S company as an expense, right? Of maybe say whatever is the interest rate. Maybe say the loan is here 40,000 and the interest rate maybe says 10%. Okay. So that means what is the finance cost? It is nothing but 40,000 into 10%, which is 4,000, right? So that means this expense of 4,000 shall be eliminated. Why, I'll tell you. So it is a finance cost for the subsidiary company in their statement of profit or loss, and in the parent statement of profit or loss, it will be an investment income, right? It is going to be an investment income because they've invested and on that they are receiving the income in the form of interest received, right? So they must have also been stated it in the P&L, correct, as an income. So this 4,000 must also be there in the income. So this 4,000 which is there as an income for the parent and which is a finance cost for the subsidiary shall both be eliminated in the consolidated financial statements preparation. That is your loan held by one company in the other. Now, dividend and loan interest. Dividends and loan interest is that if the subsidiary company is paying a dividend, right? If the subsidiary company is paying a dividend, then maybe say I've acquired 80% of the subsidiary company and subsidiary company paid a dividend of $1,000. That means how much did I receive? $1,000 is paid, out of which 80% is acquired by me. So I received $800. The remaining $200 went to NCI. Correct? So this $800 must be stated as an investment income in the parent company's financial statements, in the parent company statement of profit or loss. Correct? This investment income is there in the statement of profit or loss. Now this is mainly related to the statement of profit or loss, so I'm not going into the details of it. Okay? The interest part, loan interest, that I've already explained. Correct? Only the dividends part I'm explaining here. Now investment income of 800 I would have stated it because I've invested in the subsidiary company and they've paid me dividends, so it will be an investment income. But this will also not be shown because this is an intra-group dividend paid. Okay, this is an intra-group dividend paid, so this will also not be shown within the consolidated financial statements. Always keep that in mind. Okay, now we jump to unrealized profits on sale of inventory. Okay, unrealized profits on the sale of inventory. Now, as I told you, maybe say the parent company and the subsidiary company actually does certain transactions amongst themselves of purchasing or selling certain goods, right? So maybe say P company wanted to show a better financial position or wanted to show higher sales revenue. Okay, what did they do? P company had goods worth $1,000. Okay, P company sold these goods for $1,200 to the subsidiary company. Correct? So this is the situation. Now they will have certain current accounts if provided this is sold on credit. So the receivables and payables will be eliminated of 1200. Okay? Because see, if P company has sold it at 1200, P company will recognize a receivable of 1200. So that receivable of 1200 shall be eliminated, not of 1000. Okay, only the cost was 1000, but they sold it for 1200. Right? And for S company, it would have been a payable, right? For S company, it would have been a payable of 1200. So these two current accounts are going to be eliminated. This part I've already explained you, correct? This part you're already clear with. But here the only thing is that the cost of the goods are $1,000 and the goods were sold for $1,200. Then in such a case, there is a perp on it, right? That means unrealized profit. Because this profit, whatever the parent company has generated, that should be unrealized. Why? Because it is generated by selling an intra-group sale, right? By making an intra-group sale. So let us look into the details of unrealized profit. Okay, we are done with this part. I don't think there's anything necessary to be explained here because I've already explained you everything through the Excel sheet. You can just pause it and view it if you want to. And also this part is not done yet. I'll explain you this part, but before that we'll complete the unrealized profit. So as I told you, profits made by the entities within a group on transactions with other group entities are recognized in the accounts of the individual financial statements of the entities. But in terms of the group as a whole, such profits are unrealized and must be eliminated from the consolidated financial statements. So how will they be eliminated? It depends on who is the seller, right? So in this scenario, as I told you, P company has sold the goods to the subsidiary company. That means P company is the seller, right? P company is the seller here, right? So whatever is the unrealized profit that P company has made, right? The unrealized profit that has been made here, it is made by P company, correct? So the journal entry will be nothing but reducing this profit of PERP from the group retained earnings, right? Which is nothing but your working note 5. You will reduce this PERP from group retained earnings. It is known as PERP, provision on unrealized profit, to reduce the profit by that amount. Okay. Then 2 will be what? Inventory. 2 will be inventory account. Why 2 inventory? Firstly, see, the parent sold the goods. So the parent must have recognized a profit of 200, right? Because the good had a value of 1000 and they were sold for 1200. So parent company must have recognized a profit of 200, right? But the subsidiary company purchased it at 1200, right? The subsidiary company purchased these goods at 1200. So when we are consolidating, when we are consolidating in that, when we are having the inventory section, we will add the parent company's inventory and also the subsidiary company's inventory, correct? So maybe say the parent company's inventory is 250, okay? The subsidiary company's inventory is the inventory that is the goods that it purchased from the parent company, that is nothing but 1200, right? These are the goods that have been purchased, correct? So but actual cost of these goods are 1000, right? And when we consolidate, we will add 1200 and 250. That means we are adding the unrealized profit here. It should have been had a value of 1000, right? In S company, it should have been 1000, not 1200. But it is 1200 because S company purchased it at 1200. So in consolidation, we are supposed to remove that unrealized profit of 200. So here the two inventory account will be nothing but 200. That means we are crediting the inventory by 200. So when we are consolidating, right, at that time, when we add up the inventory of the parent and the subsidiary company, it will be nothing but 250 of the parent plus 1200 of the subsidiary minus 200, which is nothing but our PERP, right? So we will get the value is nothing but 250 plus 1000. Okay. This is your PERP when the parent company is the seller. Okay. And when the subsidiary company is the seller, then in such a case, what will happen? The journal entry will only be that your net assets of subsidiary, that is working note 2, will be debited. That means you're reducing, right? In the previous one also, journal entry that I've passed, group retained earnings, you're debiting means you're reducing the from the profit. Okay, means you're reducing, you're stating it as a negative amount in the group retained earnings. Okay, here also you're stating it as a negative amount, the PERP, as a debit in the working note to net assets of subsidiary. Okay, and 2 will be nothing but same again, my inventory, because this time the parent company purchased it at 1200. Okay, but it should have been at 1000. So the PERP of 200 shall be reduced from the inventory. So both of the cases, the credit value will be inventory, the credit side will be inventory, but the debit side will depend on who is the seller, right? If the parent is the seller, it will be working note 5 group retained earnings. If the subsidiary is the seller, it will be working note 2 net assets of subsidiary. Okay, and that will be nothing but 200 and also 200, right? So that is your unrealized profit that you're supposed to calculate. In this unrealized profit, there are also concepts like margin and markup that I will explain you while we do the sum. Okay, that is the sample questions that we are going to be doing tomorrow morning 9 a.m. to 1 p.m. Okay, that margin and markup concept we'll deal with while we are solving the sum. Okay, so these are the whole journal entries that I've passed, and it's the same. So debit group retained earnings if the seller is the parent. That means if the parent is the seller, you will reduce it from working note 5 and reduce it from the inventory. If the subsidiary is the seller, then you will actually reduce it from the working note 2 and from the inventory. Okay, now you might say that, sir, you have reduced completely from the working note 2, but technically we are maybe say owning 80% of the company. Then in such a case, you should have reduced 80% from working note 5 and 20% from working note 2, right? But that is not the scenario. Whatever is the distribution between the two, okay? When I state it as a PERP, right? So, wait, I'll show you your working note 2. Yes. So when I state my PERP here, P, okay, I'll just add one slide here. Right? So if the PERP is there, this will only be there in working note 2 if subsidiary company is the seller. Okay? And it will be reduced from here. That is the reporting date. That is going to be nothing but maybe say 200. Right? And thus this will be 37,800. And this will be nothing but 37,800 minus 36,000, which is 1,800, because it got reduced by 200, which is the PERP, right? So it is going to be nothing but 1,800. Now this 1,800, it is any which ways the reduced profit which is distributed between group and NCI. That means this 200 PERP is already allocated to the two of them. Okay, so it is allocated to the group and also to the NCI. Right? So that was the part I was wanting to explain for your unrealized profit. I hope it is clear to everyone. Only the margin and markup of it, we'll do it when in class. Okay. Now, the sale of non-current asset. So if one group entity sells non-current assets to another, adjustments must be made to recreate the situation that would have existed if the sale had never occurred. Okay, so that means, for example, if the parent company sold an asset to the subsidiary company at a value which is higher than its cost, okay, because they can do that, right? They can do that. They are related companies, they are companies within the group, right? So in order to show better profits or better value of assets, they can do that. So then in such a case, you have to make adjustments as if the sale was always at cost and the profit never occurred. Okay, so there would have been no profit on the sale and depreciation would have been based on the original cost of the asset to the group. Okay, so how will you make that adjustment? I'll just give you a quick example for that. Okay, maybe say the parent company, sold an asset worth 10,000 to the subsidiary company for 15,000. Okay, at the start of the year, and we are right now at the year end, right? So we'll just make three columns. One is with transfer, the second one is without transfer, and the third one is nothing but the per purchase. Okay, so now what is the cost of this asset without the with the transfer? It was sold with the transfer at a value of 15,000, right? What is the cost of the asset without transfer? It is nothing but 10,000, right? So what is the profit that they have achieved? It is 5,000, correct? That is nothing but 15,000 minus 10,000, right? Then it was actually sold at the start of the year. And maybe we are at the year end right now. Okay, so we have to charge depreciation and calculate the carrying value of these two things at the year end, right? So what will be the depreciation? Maybe at the date when it was sold, that means at the date of acquisition, it had a useful life of 5 years. Okay, so the useful life is of 5 years. So depreciation will be nothing but 1 divided by 5, right? So it will be nothing but 15,000 into 1 divided by 5. You will get the depreciation of an asset with the transfer, and it is going to be 10,000 into 1 divided by 5. That is the depreciation of the asset without the transfer. That means its original cost. So that means there is an excess depreciation here, 3,000, right? Minus 2,000, which is nothing but 1,000, right? There is an excess depreciation, and thus the carrying value also here is going to be nothing but, with transfer it is going to be 12,000, without transfer it is going to be 8,000, and thus the perp that is going to be is nothing but not 6,000, it is going to be 4,000, right? Because 3,000 and minus 2,000 is going to be 1,000. Okay, we're not taking two minuses here. Okay, we just identifying the difference in the depreciation, right? Only the thing is that depreciation is stated as a negative amount. So with transfer, the depreciation was 3,000, and without transfer, it is 2,000. So the excess depreciation is nothing but 3,000 minus 2,000, that is 1,000. That is how we have stated it. Okay, the only thing is that we've stated negative because we have calculated inverse of it. Okay, so why we have done that, that also you'll understand. Let us now pass the journal entry for this. So always in exam, when you are given such a sum, first prepare this column and then pass the journal entry accordingly, right? So what will be the journal entry here? Firstly, the parent company is the seller, right? So the parent company had the cost of the asset at 10,000 and he sold it for 15,000. So he got a profit of 5,000. So your group retained earnings will be reduced by the sale value, correct? I mean by the profit value. Group retained earnings account debit, that is nothing but your working note 5, right? It will be reduced by 5,000 because on the sale of this non-current asset, they obtained a profit of 5,000. Then 2 will be nothing but non-current asset, right? I'll explain you that why. And its amount will be nothing but 4,000. Okay. And also 2 will be nothing but your net assets of subsidiary, that is nothing but working note 2, right? Which is going to be nothing but 1,000. Right? So this is how you will pass the journal entry. Now, first one we understood why we have debited, because we are reducing our profits by that unrealized profit because the asset was sold unauthorizedly, I mean not unauthorizedly, but at a value which is higher than its actual cost. Correct? So why are there these two credits? That is because if the parent company sold the asset, guys, that means subsidiary company purchased it. At what value? They sold it for 50,000, 15,000. So subsidiary company also purchased it for 15,000. Correct? So that means when we prepare the consolidated financial statements, we have the non-current assets of the parent and of the subsidiary, right? Maybe say the parent's non-current assets are only 1000. Okay, it's just an example. But the subsidiary's non-current assets includes 15,000 value, that is an asset which is purchased by the parent company. Now you have to, if you add these two, you will include the unrealized profit here, right? You will include as if the sale is made at 15,000, but you have to adjust as if the sale had never occurred. That means this value should have not been 15,000, it should have been 10,000, correct? So when you adjust your consolidated statement of financial position, at that time your non-current asset will be nothing but 1,000 of the parent plus 15,000 of the subsidiary, right? Minus 5,000, which is the PERP, right? This PERP shall be reduced here because it is minus 5,000, but also there will be an addition here of 1,000, right? Why that addition will be there, that I'll explain you. That is because now if the subsidiary company purchased the asset at 15,000, the depreciation that subsidiary company has charged is nothing but 15,000 into 1 divided by 5, correct? 15,000 into 1 divided by 5. So the depreciation that they have charged is 3,000, right? But if the value of the asset originally is 10,000, the depreciation that should have been charged is 10,000 into 1 by 5, correct? That means the depreciation should have been 2,000, not 3,000. So they've charged excess depreciation, which is reducing my non-current asset, right? So I shall add it back to my non-current asset here, okay? Because that excess depreciation is reducing my non-current asset value, I will add it back because I will have to eliminate the value of 15,000. If I'm not excluding that, that means I'm charging depreciation considering the cost of the asset to be 15,000, not 10,000, right? So if the depreciation should have been 2,000, right? But it is actually 3,000, I will add it back because this much was reduced. My asset was reduced by 3,000, but it should have been reduced only by 2,000. So I will add 1,000 back to adjust that element, right? So it will be nothing but 10,000, 1,000 it is, plus 15,000, plus 5,000, minus 5,000, plus 1,000, right? That is going to be 12,000, right? This is the value of my non-current asset. And lastly guys, there was one more component here. If you can see, group retained earnings understood to non-current assets. Why we are crediting 4,000? That is because minus 5,000 plus 4,000, it is minus 4,000. Okay, crediting means minus 4,000. And to net assets of subsidiary company is 1,000. That means we are not debiting, we are not reducing from net assets of subsidiary. This PERP is added to the working note too, right? This non-current asset transfer PERP is added to the working note too. And that is why, because maybe say the asset that they purchased, its value is 15,000, right? They purchased it for 15,000. So they charge depreciation of 15,000 into 1 divided by 5, right? But the depreciation that should have actually been charged is 2,000, right? So after charging depreciation of 3,000, their value is 12,000. But if they would have charged a depreciation of 15 minus 2, it should have been 13,000. So you have to get it back to 13,000, correct? So you will add 1,000 in this as a PERP, and thus you will get the total to be 13,000 for these two. Okay, is the reason why that 1,000 is credited to the working note to that is net assets of subsidiary. Okay, so that is the journal entry that we are supposed to pass. Okay, this thing we have already gone through. Now this is the adjustment that I've already shown you. If you want to go through it later, you can just go through it later because I've already explained you on Excel. Yes. So the calculation of the reserves at the date of acquisition, this also is pretty much clear to everyone because I've already explained each and every detail here, right? Okay. Sorry. Yeah, this is not done. I just gave an example for this one, right? So I hope this part is clear to everyone, right guys? Now, I think a little bit of the chapter, maybe not a little bit, 53 slides are there. We are done by 33 slides. So we'll complete the remaining portion in the next class. That is going to be tomorrow 9 a.m. to 1 p.m. Right? So we end the session here for today, guys. Thank you so much for your patience and for you attending the class and adjusting your timings accordingly. Thank you very much. I hope this session was beneficial for you. If you have any doubts, please ask me on YouTube directly. I can directly reply to you on YouTube, or those who are my students already in Lakshya, they can directly text me on Telegram.